I'm going to start recording the meeting now.
Okay, so on your screen, everybody's got the Zoom screen, right?
Right.
Okay, all right,
Monique's going to change that shortly.
all right, good. Because I do have 6:30.
Okay, Monique, you're on.
All right, very good. So we'll get this meeting going. So I'm gonna call this meeting to order. This is the meeting of Thursday, September 22nd, 2022. And Monique, please, we do have a quorum, so.
Okay, Director Schmidt,
Here.
you want a roll call vote, yes?
Yes,
That you're asking for, okay. Director Jordan,
Here.
Vice President Bella,
here.
okay, we have a quorum.
Very good. All right, Rena, do we have any public comments?
We don't have any publics that we are aware of. No.
Okay, good. So we'll move on to item number 3, which is the agenda review.
I do have a suggestion or a request of the board. In closed session, we have 2 items. And one of the items, or the first item, the legal counsel who is going to be here for that cannot. So we have some information that Julie and I will share with you with regard to item A. Item B, Jubin is going to be a part of that closed session. So what I was going to request is if we can move item B to become item A, just basically swap spots, and then we'll do the existing litigation item second, because it's just going to be the board and Tammy and Julie and myself. Is that okay?
That's okay with me. It's okay with everybody else? I see thumbs up. Okay.
Yep.
All right.
Thank you. All right. Then that's
Anything
it.
else on any addition, deletions, or any pulled items from the agenda?
Not
Okay,
from- not from
hearing
staff.
none, we'll move on to acknowledgement and presentation for our good friend, Ron Leitner,
Yes.
water system operator, 25 years of service to the district. Rena.
Yeah, so let me start this out by saying, Ron Leitner is actually a local, I'm gonna say local young man. He was born here in Belmont, went through the school system here, as I recall, and is probably, with the exception of Tammy and Monique, the only actual operator that lives in Belmont. The rest of us all commute into Belmont. And so he's been with the district, as we're saying now, 25 years, dedicated public servant to the community here, but the community that he grew up in and has lived in. And so we just want to recognize his 25 years of service. And as we've stated, because he's probably the 3rd or 4th person in the district since I've been here who's achieved this milestone of getting up to 25 years or more. And you just don't see that nowadays in the business world. People just kind of come and go. Somebody like me, I've been through 2 or 3 different lives at work, but Ron's been here dedicated to maintain the health and safety of the water system. And we were just talking about that today in one of our safety meetings. So I think it's important to recognize Ron for his work ethic, his talents, and his knowledge. I've always been impressed with people like Ron, the men who've been here a long time. They just know the water system like the back of their hand. You can ask them about a water meter out in the middle of somebody's driveway, and they can tell you the history of that particular water service and the homeowner, and how many times they may have had to gone out there for this or that. It just amazes me, and Ron is one of those guys, and just a lot of these people just know the water system like the back of the hand. You just can't say enough things about the historical knowledge these people have. Ron is just one of these people, just very caring. He's very committed to the district and the district's customers, and I'm just glad that he's here. That's the good news about Ron. The bad news is he's ready to retire. So he's hoping that early next year, I think in February, he's going to retire after 25 plus years with the district, and we'll miss him, but wish him well. But in the meantime, we want to recognize 25 years of service. And just here within the past couple of weeks, we had our luncheon for Ron to celebrate, his 25 years, and his wife Melissa was here to join him, and we just had a nice time reminiscing and talking and telling some stories of Ron and his work ethic, and Some of them are kind of funny, but I'm not going to bring those up now. But I just want to recognize Ron and the years of dedicated service. Tammy, I don't know if you want to say something. I know Michael's here, and I think Ron was trying to get in as well. So I'm going to see if Tammy wants to say anything.
Thank you. I think I see him down there, and the things that
Oh,
I
there he
wanted to add, I was adding is just for the past 10 years that I've been here, Ron has, just learned so much, and he's provided so much opportunity for the new operators and staff to learn what he knows about the regulating stations, the pumps and the motors. And he's just always positive. There's just those people that come to work, and he's one of those ones that, even if he gets grumpy, he somehow finds a way to turn it around and find a positive in it. So Ron, and I meant to meet with him before I left for Louisiana. That's where I am right now in my parents' former living room. It's 8:30 here, but I'm definitely not as far behind on time as you guys have been, who've traveled out of the country. But he and I meant to meet, and I wanted to tell him that we'll do that when I get back, to get his formal estimate letter from CalPERS. I'm very proud of him. He's one of the ones that's always stuck to his guns and made his retirement plans when they come up in February. And I'm going to help him achieve those and make sure that he gets there right along with Jeanette and me early next year. So Ron, again, congratulations. I think 25 years is amazing. And I'm certain that you're going to be passing along as much knowledge and information as you can in these next several months to the new staff that we have. And you're going to do it with a smile on your face. I'm certain of it. So thank you, Reno.
Sure. Thanks, Tammy. Michael, would you like to say something? You're a supervisor.
Sure. Can you hear me?
Yes.
Okay, good. Ron and I spoke before the meeting, and we decided to keep all the really juicy stuff for his retirement party. So I'm not going to say a whole lot, but we're really looking forward to him finishing out his career, and it has been very enjoyable working with Ron. He definitely is someone who has the energy to want to just go and do and get something done. And I've always appreciated that about him. So I look forward to, I wish I could say years with Ron, but unfortunately only another 5 months or so. But there's a lot that I need him to do for me in those next 5 months. So I'm looking forward to that. And thank you, Ron, for being a great coworker and a good friend.
Yeah. Thanks, Michael. So I'm going to turn it back over to the board president, and then maybe after that, we might see if Ron has anything he'd like to add.
Sure. Anybody else has any comment about Ron? Hands. I do, because I've known Ron 23 out of those 25. When I came, he was here already. So, I'm not going to repeat what has been said already, because I agree it's a ditto to me. I agree with all that has been said already, and it is true. I know Ron as being always positive, and I've seen him sometimes, in passing or in traffic going, and we wave and all that, and at the district, he carries himself very, very well as far as his attitude and his composure, and I really appreciate that. He's always positive. He's a local boy. we call him young man. He's a local boy, and he has not only the the good benefit of the district at heart, but he has the whole city as this is his home city and home. He's from Belmont, and he has Belmont at heart. So Ron, I wish we weren't talking about 5 more months, but obviously we want to wish you whatever you want to wish to yourself, and we want to wish you all that your heart desires as far as plans for the future. There is another life after retirement, and we wish you all the best. Congratulations. It was a pleasure, and we'll value the few months that we have left. So take care, and all the best to you. Okay. Anybody else? That's it. Okay. I see Matt has joined us.
Yep.
All right, cool. Okay, so we're ready to move on. We'll move on to the next item, which is the consent agenda.
What about Ron? Did Ron want to say anything?
I guess. Ron, can you turn your audio on?
Yeah, by all means, Ron, if you can.
Doesn't look like it. He said he was on a laptop. I think his wife's laptop, so it might be a little bit more
Yeah, he's still
difficult.
on and he's on mute.
Yeah.
So I'll give him a couple more seconds. Ron, can you hear us?
I think he can. I think he just can't he can't
Unmute
have any
himself?
audio. Yeah.
Yeah.
So let's go forward.
Okay, all right, we'll move on then. So the consent calendar, anybody want to pull any item from the consent calendar or any questions? I cannot see everybody, so you're waving your hand. I cannot see you. Okay. Jubin, are you waving your hand? No. Okay. All right, seeing none. Okay, do I hear a motion to approve the consent calendar?
Kathy has her hand up.
Kathy,
Yeah, so I shared this with staff earlier today, but just a grammatical correction on the minutes for July 28th, line 181. The district intends to record this water service agreement. That's all.
I
okay,
see it.
all right, very good.
And
Brian,
yeah, I shared a correction too with staff. I
Yes.
assume that's happened. I can't pull it right now. Monique had it. I already sent it to me.
okay, very good. So Rena and Monique, you have those corrections
We do.
already taken care of? Okay.
We do.
Excellent. Okay, very good. So do I hear a motion to approve with those corrections?
Motion to approve?
Okay, motion by Director Schmidt, second,
A second.
second by Director Jordan. All those in favor, say aye.
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 Opposed? All right, thank you. All right. Next, hearing and
Louis,
appeals.
I'm sorry, do we need to do roll call for these? Do you know?
Sorry, I was double muted. Yes, because we're teleconferencing, we do need to do roll
Okay.
call.
All right, cool. So Monique, please roll call.
Okay, Director Jordan,
Yes.
Director Schmidt,
Yes.
Director Zuka,
Yes.
President Bella.
Yes,
Okay, we have motion passed 4-0.
all right. Thank you. All right, we'll move on to number 6, hearing and appeals. We have none. Moving on to item number 7, Mid-Peninsula Water Fiscal Year 2016-2021 Capital Improvement Program and 2016 COP. Financing, none. Anything else on that, Rena?
No, we don't have anything in item 6 or 7 of the board.
All right.
package.
Very good. All right, good. So item number 8, consideration of resolution 2022-23. Rena,
Yes. So thank you. So before the board tonight is a consideration as to whether the board would like to take some of its cash reserves that are currently all in LAIF and invest them in U.S. Treasuries. This all started, you may recall, back on June 13th, the board received a piece of correspondence from a Stephen Gortler, who is actually at this meeting tonight, just saying, hey, board of directors, were you aware that you could take your LAIF reserves or cash and place them in U.S. Treasuries because they're paying a lot more interest than LAIF. And at the time, the board said, hey, is that something that we can do? And you asked Tammy to look into it. And so she did. She contacted the municipal finance advisor, Wolf Hansen, Bud Levine, who's also in the meeting tonight, and his partner, Rob Pankratz, and now also Stephen Gortler. And they prepared a memorandum, just kind of outline what this program is all about. And here in early September, we met with the board finance committee to kind of go over this process and describe what the program was all about. And board president, Mr. Wheeler, and vice president, Mr. Vela, say, hey, why don't we bring this to the board's full consideration and see if it's something that they want to do. So that's what this matter is. It's a resolution that would authorize the board to take $5 million or as much as $8 million or an amount of the cash reserves that the district has from LAIF and put into an established investment account in U.S. Treasury notes that's providing a higher yield than what LAIF is providing. Along with that, there's a $25,000 in fees. There's some one-time fees. It's a little under $16,000. And there's another $8,500 in annual fees to help process this. And so that's also part of the resolution. And then the last thing is for the interim general manager to execute all the documents that would make that happen. In the staff report, we just kind of talk about that also and give the board several different alternatives that they could consider, anything from the $5 million to $8 million or some number in between, or to do nothing at all and just kind of stay pat where we're at. But we're just happen to be in a unique opportunity that this can happen. And then also we researched, the board's history, and there is a board investment policy, a policy that was approved by the board back in 2011. And on page 44, Monique, if you go to page 44, I want to just kind of highlight that. Yeah, page 44, as part of that resolution of the board's investment policy, item 7A, authorize investment instruments subject to board approval. And 7A says U.S. Treasury notes, bonds, bills, or certificates of indebtedness. Those types of things are also investment opportunities for the board, again, subject to board approval. So with that, we have asked Wolf Hansen to come here tonight, and they have a presentation to kind of give the picture to the other members of the board who weren't a part of the finance committee, just to kind of explain it. We tried to explain it in the staff report and hopefully did a good job there, but they're here to try to give you again an overview and then answer any questions that the board may have. And then we'll see if the board wants to proceed with this or stay where we're at. So what I'd like to do now is turn it over to Mr. Levine and to Mr. Pankratz. And I think Monique has their presentation that she's going to put up on her screen, and we'll control the slides based on Mr. Levine or Mr. Pankratz's request.
Terrific. Well, thanks, Rena. And by the way, I thought you did an excellent job on the staff report, so that adequately really discussed and pointed out all the key elements that we had gone over in the finance committee meeting. So before we get involved in the actual description of the program that we have, I'd like to remind, I think everybody knows who we are that's on the board. There may be some new members that I know were not around when we previously did some work. So I thought I would do a quick background on Wolf Hansen and the participants tonight. Wolf Hansen was founded in 1931. We're one of the oldest public finance firms in California. We have 6 registered reps that provide municipal advisory work. We recently have completed advisory work for Woodbridge Irrigation District, North Coast County Water District, Big Bear Municipal Water District, City of Marysville, City of Mill Valley, City of Porterville, City of Coalinga, Indian Wells Valley, Groundwater Authority, which is in process. So those are the recent engagements that we've had involving our services. I've been in the business for well over 50 years. We were introduced to the Mid-Peninsula Water District in 2016 by Rena, who previously had been the city manager at Coalinga, where we had provided both underwriting and advisory services. So when the district decided they would like to explore the possibility of using debt for capital improvements, he introduced the district to us. We met with Tammy and staff, and over a process, we were able to, I'll get into that in a minute. Rob, you want to just give a brief description of the involvement and background?
Yeah, absolutely. So hi, everyone. I'm Rob Pankratz. I've met a few of you at the finance committee meetings before. It's nice to see you all tonight. I've been working with Wolf Hansen in public finance for just over 5 years now. I worked briefly with Mid-Peninsula on some of our consulting work in 2019, and I'm happy to be here tonight to walk you through part of this presentation.
And I think I'll leave it up to Stephen to introduce himself, but when he will be doing the start of the presentation, so I'll let him introduce himself as part of that process. Our history with Mid-Peninsula, we were originally retained in 2016 to advise on the financing of the capital improvement project. That led to the issuance of the 2016 COPs. Our services during that period included educational workshops with various board members and other consultants, the rating agency presentation, the structure of the financing. We went through the analysis of whether to do a competitive sale or a negotiated sale. At that time, since it was the first bond issue that the district had been involved in, it was suggested that we do a competitive sale so they could see how they could get the best interest rate. We did that. It was a very good sale. We didn't quite hit the market at the absolute low of interest rates over the last 30, 40 years, but we came close. And part of that was we wanted to be sure that everybody on the board at the time was comfortable. There were some on the board that were unsure whether they should get involved in issuing debt. And it was a good involved process, a lot of discussion, and everybody came to the conclusion that this was the best for the district, and it was a very successful sale. On the PowerPoint here, it lists some of the projects that where the funds were utilized. We've continued to be a value-added member of the district's financing team. We provided the debt management policy. We recommended a consultant on the expenditure of project funds for reporting to the board, Dan Bergman, who I know to this day still provides services to the district. We also did some modeling for possible refundings based on the market conditions. Up to this point, the conditions have not been efficient enough for a refunding to be utilized that would make sense for the district. So those bonds remain outstanding. With that, I'd like to turn it over to Stephen to introduce himself. By the way, Stephen had approached the district about doing this program, and Tammy had contacted me, and I said, we had been considering doing a program very similar. We did have discussions with Stephen. At the end of the day, he felt it was a good fit, and we also felt it was a good fit for him to join our firm to not only provide this type of a service in conjunction with our efforts, but also to do general municipal advisory work also. So we're delighted to have him on staff with us. And with that, I'll turn it over to Stephen to start the process of walking you through this presentation.
Great, thank you very much. Can you guys hear me okay?
Yes.
Great. Yes, just a very, very brief background on myself. I've been in public finance for 30 some odd years. And for the last about 25 years or so in California, working with the cities and special districts, helping them to issue debt to help pay for capital projects or to refinance outstanding debt. That's been the lion's share of my career for many, many years. As you know, just in the last several months, with the quick rise in interest rates, I got more involved in investments. It's been an issue I've been involved in on and off over many years, but now it's become more of a mainstay. And so I'm really excited about joining Wolf Hansen. It's only been a week or so, but it's been a whirlwind, a lot of opportunity, a lot of excitement, and I'm really looking forward to working together with Bud and the rest of the team. And hopefully, what we've got to show you tonight will be something that will be of value. I'll keep going. Stop me along the way. Ask me questions. If I gloss over something, just call out my name and I'll stop and take questions. So right here on this page, it says late allocation. A lot of the stuff you'll probably know, but I'll go through it quickly anyway. According to the district's information, you had about $13.6 million invested in the local agency investment fund, or LAIF, as of a few months ago. Just a little bit of background on LAIF. You may know some of this, but go through it anyway. It's a very popular investment for California cities and special districts. primarily because it's a very low cost and convenient type of investment. It's very safe and it's very liquid. So, there's probably 1,000 special districts in California that have over time invested their money in LAIF, along with hundreds of cities and so on and so forth. Notwithstanding its many advantages, however, one of the disadvantages, especially today, is that LAIF pays a relatively low interest rate or yield as compared to the current yield on United States Treasury securities. And that's really the whole genesis for why we brought this to your attention, and why a lot of special districts in California are looking at something like this. On the next page, I'll go a little bit further. Can we scroll down? Yeah.
Yeah.
So on this graph here, it's a little bit hard to read, but I'll go through it a little bit slowly, because I think this graph really, it captures the essence of what we're talking about here. Yes, that's good, thank you. On the bottom there, you can see there's like a dashed black line from left to right. You can see it's gradually rising over time. That's the yield or the interest rate that LAIF has been paying to their depositors. So back in August of 2021, roughly a year ago, you can see it was right around 0.25%, which is like an all-time or near an all-time low. Similarly, on the left-hand side there, for August of 2021, all those bars, the bars of the chart, those were the various United States Treasury securities for a 3-month Treasury and a 6 and a 9-month Treasury and a 12-month Treasury. And as you can see, the interest rates that Treasuries were paying to investors was almost zero. I mean, unheard of, really. And that was the situation in the aftermath of COVID for quite some time. Gradually, though, beginning earlier this year, you can see in January, February, you can see the Treasury yields started to rise quite dramatically. These bars represent the average monthly yield of each of those Treasuries. So, for example, in January, you can see the 1-year Treasury security was earning or paying a little bit more than 0.5%. And then gradually from January through February through September, you can see it's increased at a very rapid clip, unprecedented really in many, many years. The reason being that, as you probably know, inflation has become a big problem in the economy, and inflation is one of the biggest drivers of interest rates, along with federal policy. And so we've seen a rapid increase in Treasury rates from virtually nothing to today. On the far right-hand side there, you can see some of these rates are averaging near to 4%, 3.75%. Again, these are average monthly rates. If you look at the daily rates, they're even a little bit higher. So quite a rapid increase. But on the other hand, you can see the black dashed line, which is the LAIF rate that you're earning with your money, that has increased, but much, much more slowly. And there are a lot of reasons why, but suffice it to say that the LAIF rate hasn't nearly kept pace with the Treasury rate. And so it's created an opportunity for people to take money out of LAIF, put it into Treasuries. Someday it's certainly possible that the LAIF rate will eclipse the Treasury rate, and maybe it'll make sense to get out of Treasuries and go back into LAIF. But right now, the tables have really turned, and I think the graph kind of illustrates that there's just a lot more money to be made in Treasury securities than there is in LAIF.
Stephen, I wanted to add a couple of things to that. Maybe some of you know this, but just for a quick review, the way interest rates are determined. The Fed sets the policy for the very short-term interbank lending rates, which affect the very short-term treasuries. So when they raise that rate, those treasuries go up, and that's what's being experienced right now. The bond market sets the longer rates, the 10-year, the 20-year, and the 30-year treasuries. That's based on who's buying, who's selling, and the market condition. But as long as the Fed is raising, and the reason they're raising interest rates in the short run is to try to fight inflation. If any of you listened to Jay Powell, the chairman of the Federal Reserve, yesterday, when they did a 75 basis point increase in that Fed funds rate, he's indicated that they are going to continue to raise these short-term rates until they break the back of inflation. Inflation has been running at 8.2. It was running much higher than that, but recently it's 8.2, 8.3. They want to keep raising short-term rates until they can get that inflation rate down to somewhere between 2 and 4%. So the reason this program, I think, is going to be very attractive, particularly as Stephen explains more about it, is that there's going to be reinvestment opportunities that are going to be generated as these laddered portfolios roll over. So it is very indicative right now with the Fed continuing to be on this policy of raising, that certainly for the next 6 months, year, maybe even longer, there should be consistent increases or at least stabilization of these rates at these higher levels. But I just wanted to point that out to those of you that may not be aware of it. Go ahead, Stephen.
So question, but
Yes.
so on the short term, you're talking 12-month treasury bill is still considered the short term, correct?
Yes, the short term, actually, very great question. It's if you get into the weeds on this, the short term is considered from 3 months to 2 years. And in fact, the 2-year rate has generally been the indicative rate of about where those rates will go as far as the Fed raising. And right now, the 2-year is at 4%, but also the 1-year is close to 4%. So those are the short rates. And you could even extend that out to the 5-year treasury. Once you get into the 10-year, 15-year, 20-year, and 30-year, those are all set by the market. And that's why we actually have just one more thing to bore you with, what is called an inverted yield curve, which means that the shorter term rates are actually higher than the longer term rates. The 30-year treasury is at a 3.50 and the 2-year treasury is at a 4%. Well, why is that so? Because the Fed is raising the short-term rates. That's going to trade off of that raise. The market is concerned that these increases in the short-term rates are going to cause a recession. If you have a recession, long-term rates go down because there's less demand for money. In fact, people are selling treasuries rather than buying them, and therefore that rate goes down. And as a result, you have this bifurcation in the market with this inverted yield curve. I'm sorry, people will be buying those because they'll be buying the long bonds because they're less concerned about inflation at that point because you have a recession. So that's why we have this unique opportunity to be doing this.
Yeah, thank you. Because the next question was going to be to you or to Steve. You know, we have been used to this stable interest rate, which has been the same for so many years now. And now all of a sudden, you know, we're looking at the Feds. What are they going to do this month? What are they going to do next month? And it's just like whatever we discussed at the finance committee meeting just three weeks ago is totally different than it is today, than it was, you know, yesterday when they went the 75 points up. You know, it's just like, where is this going to end? And all this short-term treasury is changing so rapidly now, which is what's going to be my next question. But you basically answered.
No, I can give you a little more flavor on that because you're absolutely talking of exactly what we in the business are talking about on a daily or multi-daily basis.
Mm-hmm.
Because my career being in this business so long, I mean, I, like you, remember the days when a 15 or 20 or 30 basis point move from, let's say, from 3 to 3.25 would take a year to take place.
That's
to go
right.
from 3% to 5% would be a 5-year period. Now we get that in 2 weeks.
In 2 weeks, yeah.
In fact,
exactly.
when we
25.
You'll appreciate this in just a couple of minutes. When we met with you September 9th, which is when we put together the memo, the rates were at a certain level. When we did the savings analysis and all of that, you're going to see that just in the space of 13 days, the rates have gone up anywhere from 25 to 40 basis points, just in that small period of time. And why I'm confident that these, or at least nobody can be absolutely sure that these rates will continue this way for a little while longer, is that the Fed's target is to get the Fed funds rate up to around 4.5. Right now, it's around 3.25 to 3.5 on the real super short term. So there still are going to be some further increases. Then I think once these increases creep through the economy, controlling inflation, I think we're going to get back down to a more stable environment that we've been used to in the past.
Yeah, thank you.
Lewis,
And we
Brian
have
has
a question from Director Schmidt. Go ahead.
Yes, thanks. I think I understand this. Let's hopefully just confirm it. That when a treasury note is purchased for a certain rate, it retains that rate of interest no matter what happens afterwards.
Absolutely. Now, well, here's to a certain extent, yes. The bottom line is when you buy a 2-year treasury at 4%, if you hold it to maturity, it's not going to change. It will pay off and it will pay you 4%, no matter what happens in the economy. However, and Stephen will get into that a little bit later in the presentation. If you know, I'll just jump ahead on that. If you buy a 2-year treasury at 4%, and next month the interest rate goes to 4.1, if you wanted to sell it and there's an immediate market, a daily, hourly market in treasuries, you might have to take a slight discount on that, but it would be very slight because it's so short. But it's only if you sell it in the open market and that you would not get the absolute par amount at 4%. If the interest rates go up, then that value of that 4% is going to go down slightly. If the interest rates go down, the value of that 2-year 4% will go up slightly. That's why we keep everything short within 1 year at the maximum 2, and that there always have the roll. And Stephen will show that to you. And what I'm just said will make more sense when you see the laddered portfolio.
Okay, the reason why I was asking that is was wondering if there's any risk that the relationship between LAIF and these T treasury bills might change in reverse. Then it's not a problem. We just hold on to those treasury bills.
Exactly. And Stephen went into that a little bit. And yes, you're absolutely very astute to have asked that question. That is absolutely correct. LEAF will probably start to catch up, but you notice it's catching up at a slower rate where it's actually losing ground right now. It may have a period where it will catch up because it's true. And also, in addition to others, is investing in treasuries, but they're staying much shorter to keep the liquidity factor that they have to have because they have to do the same thing. They're investing in treasuries. You need the money. They've got to sell those treasuries to raise the money to pay you when you're taking money out. So yes, the relationship won't always stay exactly as it is. We have an example, by the way, further on in the presentation about what happens as LEAF goes up from where it is now at a certain level and what effect that would have on the earnings. But it sure appears to us, at least for the next couple of years, that that ratio will be such that you'll be getting much better returns doing this particular program.
Great, thank you.
Sure. Okay, students, so sorry, go ahead.
Sure. Okay, so if nobody has any more questions on this page, we'll go to the next page. Yeah, so this is just a little bit of background information on Treasury securities. You may know already some of this information may be familiar to you, but we'll go through just for anybody who doesn't. What we're saying here is that the district may want to consider investing in what we call a laddered portfolio of Treasury securities. And we'll talk about what a laddered portfolio is in a moment. Treasury securities themselves, as Bud mentioned, are very, very liquid. It's a very large and broad market for Treasury securities, widely considered to be the safest and the most liquid investments in the marketplace. Treasury securities are issued by the United States federal government to pay for their day-to-day operating expenses, for defense and entitlements and the like. And it's a vast market throughout the world. People are always buying and selling Treasury securities, so they're very liquid. Let's see. So here we say a laddered portfolio offers the flexibility to design an investment portfolio that exactly meets the cash flow and liquidity needs. So what we're saying here is that we're not just talking about buying Treasury securities, but rather we're talking about constructing a portfolio of Treasury securities, which is specifically designed to produce a cash flow that meets the cash flow and liquidity needs of the district. And we'll show you the numbers for that in a moment. But it's important to note it's not only just Treasury securities that we're talking about, but rather the combination of securities that is designed with certain maturities to produce a cash flow. And I'll show you that on the next page. Here on the last line there, it says a portfolio with quarterly principal maturities and a 1-year term. So it's a little bit hard to see here, but this graph or this table here is an illustration of what a hypothetical portfolio would look like. So I'm just going to go sort of from top to bottom on the numbers here and try and explain what it amounts to, and hopefully it'll be clear. So on the left-hand side there where it says date of investment, we made the assumption, arbitrary assumption, if you will, that the investment would occur on October 1st. It's a, it could be a different date than that, but that's the assumed start date. And then further, we assumed that the district would invest $5 million in this case in a laddered portfolio of treasuries. So we take on 10/1/2022 one of the four maturities, $1,250,000, and invest it in a 3-month treasury security, which would mature 3 months later on December 31st. And the interest rate or the yield on that treasury security would be 3.37%. And that would produce interest income for the district over that 3-month period of $10,531. So one security, $1,250,000, a 3-month treasury, it matures, you get $10,000 in interest, and at the end of the 3 months, the Treasury Department will wire to your bank the principal amount of the investment, the $1,250,000. So immediately, 90 days after the first investment, you get $1,250,000 back in your bank account, and that's the liquidity, that's the cash flow that a laddered portfolio produces. So if you need the money for operations, if a capital project needs to be funded, or if an emergency situation should arise, you've got that $1,250,000 in the bank, and it's yours to spend. If you don't need the money for an actual expenditure, then you may choose to reinvest that money and put it back into the marketplace. So similarly, on October 1st, you would also buy a $1,250,000 treasury with a 6-month maturity, and that would earn 3.87%, another with a 9-month maturity, and that would earn 3.96%. And then lastly, the fourth of the 4 treasuries that you would purchase in this example would be a 12-month treasury. So as you can see, 3, 6, 9, 12 months, every quarter, another $1,250,000 treasury security would mature. And then the Treasury Department would wire your bank your principal investment back. And then that money is on hand to pay for capital expenses, operations, and so forth. And that's why it's called a laddered portfolio. It just goes from one to the next maturity. You keep getting your money back. If you don't need it, then you could reinvest the money back into the market. So below the first 4 investments on 10/1, you can see there's a 1/1/2023. And that would be the day after the first 3-month period ran. And that would be an opportunity for you to then reinvest that $1,250,000 back into the market. And you would invest that in a 12-month treasury if you wanted to keep the same structure of the portfolio. Bear in mind, the 12-month security that you bought originally is now only a 9-month treasury because 3 months have passed. And so there's a sort of a rung on the ladder at 12 months. So you can put that $1,250,000 back into the ladder, a 12-month treasury, and that would be earning in today's market, or as of interest rates as of the 19th, a couple of days ago, a yield of 4.05%. And during the balance of the first year, that would produce $50,000. And then the next 2 rows would just simply be each of the reinvestments of the quarterly principal maturity that occurred after the 6-month security matured and the 9-month security matured. So over the course of the entire first 12 months after this initial investment, it would produce interest earnings of $198,000, which amounts to a return on your investment of 3.97%.
Stephen, why don't you pause there? Because I have a couple of comments and we want to see if anybody has any questions. One comment is we did this, I believe, for what was the date of the value of these? That
19th.
That's the 19th. The original presentation to those on the finance committee and Rena and Tammy, these numbers produced $180,000 and a yield of 3.60. So you can see in just the space of
10 days,
10 trading days or 10 days, the rates have gone up to where you've got a 30 basis points higher return and about $18,000 more on the gross earnings. Now, I wanted to point out something else that fits right in with the laddered approach. as the fact that every 3 months you're rolling and you're getting the money wired in and you've got that available. Rena had asked a question at the Finance Committee meeting that what happens if an emergency occurs for whatever reason and money is tied up and you have to look to get the money from this particular structure. Depending on where that happens, you would take a look at the first investment that you have, the one that's 3 months. Let's say that happens 60 days into the program. That bond, that note will mature in 30 days. If you had to sell it, that's the one you would sell. There would be, no matter where rates have gone, there would be a very, very small reduction in the yield that you would receive on that, probably in the hundreds of dollars or maybe 1,000 at the most if you had to liquidate, because you're liquidating that very short note that has even shorter time to run until it would mature. So, and any time that would occur, you're always going to have a 3-month security that's either 33 months out to pay or 60 days or 30 days. So there's constant super instant liquidity that you would get from doing that at a very minuscule risk. In fact, the way rates are going, you probably would have a chance to make money because of in case the rates pause or drop a little bit. So anyway, just wanted to make sure that everybody's comfortable with that, because I know, Rena, that was a concern that you had.
Maybe we should stop for a second and ask if anyone has any questions. I know I went through that kind of quickly, which I tend to do, but it's sort of the critical kind of the plumbing, if you will, of a laddered portfolio, this quarterly maturity and so forth. So I just want to make sure everybody feels that they know what we're talking about.
Let's slide the picture to the right so we can see what's on the left-hand side there.
Yeah, that's a good idea. Stephen, you might want to point out at each reimbursement time, there's a review that you would be conducting with the staff in determining what the needs are going to be for the district. That's what that yearly fee for the upkeep is geared to.
Yeah, that's a good point. Thank you. It's not really like an automatic pilot situation. At every point in time, we would meet with you at the end of each quarter and present to you, where's the market, where's LAIF, where's the treasury market, what does your portfolio look like? You would share with us what your cash flow and your liquidity needs are. And we would make sure that if it's appropriate, that we would reinvest that money for you. But if it's appropriate not to reinvest, if you have a need for that cash flow for some purpose, then we'll make sure that that money is held liquid for you. And then as far as reinvestment goes, there could be a situation where you may have a preference for a different kind of reinvestment, a shorter term or a longer term reinvestment, either increasing or decreasing the size of the reinvestment. It's kind of it's a continuum. And so every quarter we would meet with you and make sure that the sort of the assumptions that we made during the prior quarter and when we set this up are still valid, and make sort of mid-course corrections, adjustments, if you will, each quarter, so that the portfolio continuously is designed to serve your needs in terms of cash flow, in terms of liquidity, and so forth. So
why don't we go over that summary on the left, and then that's further discussed and shown in the next slide. But why don't you quickly do that, Stephen?
Sure. Well, okay. So this is an example of a $5 million portfolio. It generates a yield of 3.97% to $198,000 of interest income each year, based upon today's interest rate as of the interest rates as of the 19th. There are fees and costs and so forth associated with creating a portfolio. There's a one-time upfront cost to create the portfolio of roughly $15,000. And then after that, each annual period, there's a fee for various services, which we'll go over later, the details, but there's an annual fee of roughly $8,500. So if you take all those fees out of the interest earnings, that leaves you with a net yield of about 3.48%, down from the 3.97%, or $174,000 rather than the $198,000. So really the benefit to the district from doing this is really more accurately reflected in $174,000. which in comparison, that would significantly, roughly more than double actually, what the LAIF yield is currently paying. So even after all of the fees and expenses, there's still quite a substantial benefit over and above what LAIF is paying today from doing this.
And we show that in a later slide too, so.
Right. So if I could just chime in really quickly,
Yep.
One difference between a program like this and a program like LAIF is all of the fees are paid out of cash in a program like this. In a program like LAIF, all of their fees and their costs to cover their administration and setup, that's all baked into the interest rate that they pay out in interest. So we like to think that from a fee standpoint, this is a little bit more of a transparent way to go about things.
Any questions before we go on?
So, Steve, so the first year you have about a 12% fee, correct?
The 15,000 divided by the total amount of the investment, is that what you're referring to?
No, I'm talking about the total fee divided by the gross income, because the capital is ours anyway.
Right, so 24,000 divided by $5 million, basically.
Yeah, you normally, you normally don't do that calculation that way. You normally show what is the fee for the amount of money you're investing in, just like you would if you were buying a stock. The stock isn't, you don't pay a fee based on the dividend or the earnings. You pay a fee of what the gross amount of the stock is, or a bond.
Yeah, but okay, I'll be getting a gross income of 198 the first year, correct?
Yes.
And out of that, I still have to pay 24,000 for the 15,000 for the one-time fee, and then
no, you're not paying it on the 174. You're paying it on the 198. You're going to receive 198,000, and then you're going to pay this fee. The setup fee you pay of 15,750 is going to be whether you're in 1 year or 2 years or whatever. That's only paid once. After that, the review that we're doing every quarter to make sure your reinvestment is being handled properly, and the fees of the bidding agent in replacing the bonds that you're now reinvesting in is all wrapped up in that 8,500.
And that's 8.5K. Okay, good.
Right.
Annual. So let's say after 3 years or 5 years, we decide to go back to LAIF.
Sure.
So
totally
we pull out, and then from this program, and then if we were to go back in, then we will again pay that one-time fee.
We haven't really. That's a very interesting point, and we need to talk about that among ourselves of how we would do that. What do you think, Stephen? I mean, I would think that if it's not too much of a long period of time, that would just be part of the process that you're transferring into LAIF until you see if the rates come back, and if they maybe have something that as long as that's done within a year or so to get back in, we wouldn't charge a new setup fee.
Just like the initiation fees, you don't pay it more than once. Come on,
right?
Brian.
Right, exactly. Yeah, I think we could talk about that, certainly.
All right, okay. I just wanted to bring it up.
You're a good client, and we've been doing a lot of work with you over the years, so we could certainly look at it that way. Yeah.
Okay, go ahead, Steve. Thank you.
Okay.
Any more questions, anybody, by the way? I don't see any raised hands, so, all right, go ahead, Steve.
Okay, so we'll go to the next page. I think we have another example. Yeah, so this is the same basic concept. The difference here is that it shows what would happen if it were an $8 million laddered portfolio. When we met with the finance committee a couple of weeks ago, there was some discussion about what's the appropriate amount of reserves and capital that the district has that might be suitable for this kind of investment. There was a discussion of 5 million, there was a discussion of 8 million. It seemed, from what I could tell, it seemed to me like the right number was somewhere in there. So we put together sort of the bookends, the 5 and the 8 million, just to show you what the two sets of figures would produce. So this is just another example of the same basic approach for investments of treasuries, each of, in this case, $2 million, 3, 6, 9, and 12 months. The yields are the same as the yields that we showed you previously. The only difference here really is that you're investing a little bit more money 8 million. So the earnings, if you will, the gross earnings, $317,000, which is, basically another, I don't know, 40%, 30% more than on the $5 million investment. And then on the left-hand side, you can see sort of the calculations here. $8 million, the same 3.97% yield, $317,000 gross income. The fees, it's interesting here, the fees don't really change. Although the investment amount has gone up and the earnings have gone up, the fees don't change. So they constitute a somewhat smaller share of the total, which is just the nature of these kinds of investments. There are certain fixed costs that are the same regardless of how much you invest. Some of them are variable, some of them are fixed. So then the net yield is a little bit higher because the fees are a smaller percentage, so it's 367. That leaves you with a net income or net earnings after fees in the first year, $283,000. Again, that's substantially more than what Lath is paying you today. And so,
Stephen, by the way, when we be consistent, when we made the presentation to the board, the first analysis we did after we made the presentation, when we ran the numbers for 8 million, we came up with 288,000 instead of the 317. The increase in the rates has increased that now to 317. So in that short period of time.
Right. So really the difference here is $5 million an appropriate amount, is $8 million a more appropriate amount. Obviously, more interest earnings to be realized, but then you'll be putting more of your money into the market. It is a very, it is liquid. It's designed to produce liquidity. And so it may or may not be a problem to put more in, but that's really an issue that you need to assess, and we can assist you with that. I'll go to the next page if there are no questions.
So go ahead, Stephen. Here's the analysis in comparison to Lath.
Yeah, so we just compare what the market would produce in the way of treasury securities on a $5 million portfolio. There's the $174,000 as compared to a 1.5% yield from Lath, which would produce $75,000. So net of expenses, a $5 million investment would produce roughly $99,000 more for the district being invested in treasury securities than in Lath.
And that would be over one. That would be over 1 year.
Over 1 year. And again, it's important to note that that's assuming that today's interest rates remain, steady for that period of time, which may or may not be the case. I mean, as you've seen, interest rates are quite volatile. They're rising steadily, and so the results could differ. So then on the next page, same thing with an $8 million portfolio, just showing what would be a net benefit from investing in a portfolio of treasuries as compared to Lath. So $293,000 from treasuries versus $120,000 investing $8 million in Lath. Again, $173,000. My observation would be that that's quite a substantial benefit over and above what Lath is producing. It's going to take quite a long time, as Bud alluded to earlier. It's going to take quite a long time before Lath closes the gap, where it's actually better off being in Lath than in treasuries. That may happen eventually, but it's so far away right now that it's hard to conceive that it's going to happen anytime soon.
And let's take a look at the next slide, because we were not sure whether we wanted to do this or not, but we figured I think it's worth certainly showing you an example consistent with what Stephen just said, which is that let's assume for a minute that over the year, Lath, which is now around 1.5, ends up going to where they're for the year average 2%. And let's keep the treasuries the same, even though there would be an indication if Lath is catching up like that, certainly the treasuries would be getting higher yields too. But we eliminated that. We tried to be super conservative from that point of view. And you can see what the difference would be for the 5 million scenario and the 8 million scenario if Lath ends up with a 2% average yield from the 150 as it progressively starts to catch up a little bit. You can see it's still very substantially above.
Right. I think this actually is a good a good illustration of the robust nature of the benefit. Even if rates were to increase quite a bit and the treasury yields were to remain where they are, the benefits are still substantial. And so it's a good, you know, it's a good deal, so to speak. Questions before we go on? All right.
Yes, Steve, you have a question. Kathy? Director Jordan,
Yes.
please go ahead.
Yes, thanks. So just in the abundance of, because I'm just really super conservative fiscally, in the event that we needed more, I know you talked about emergency funds and you take the 3 month. What if we needed more than the 3 month? What if we needed the 3 month and the 6 month? Would it be the same or?
No, it wouldn't be exactly the same, but very close to the same. The only time you would have a big difference if rates change and you're selling out of a treasury is if you're looking at a 30-year treasury or a 20-year treasury or even a 10-year treasury. As you get shorter, there's less impact on having to liquidate. You could liquidate the entire 1-year portfolio and it would not have a very major effect at all on the yield that you would have received. You still would be receiving higher than what you would have had in LAIF, even in that worst case situation, or you should.
Okay, thank you.
And the good news about it is there's probably no more liquid security in the entire world. That includes every other country's currency than the US Treasuries. That's why whenever there's world unrest, there's a flight to quality and all of the other countries' investors flock to our treasuries. So there's a constant billions of dollars in treasuries are traded every day, every hour, and during the trading day. So you can't have a more liquid investment.
We'd go as far to say as if you had to liquidate your entire portfolio, whether it's in LAIF or treasuries, if it was in treasuries, it could be liquidated slightly faster than it even could in LAIF. If it's above the threshold for LAIF, which I believe is $10 million, where they require extra notice to liquidate.
Okay, thank you.
Sure.
Other questions? Okay,
Go ahead, Steve.
Go on to the next page. Okay, so you know, we kind of made a list of what we think are the key attributes or the benefits, if you will, of the approach that we've designed. So I think it's worth spending a moment going through them. It may trigger some questions or whatever. So the idea of the laddered portfolio, we say here it can be created and maintained at reasonable cost. It's very easy to understand. It's very easy to administer. It's very easy to modify and to track performance. You know, we make these statements as compared to other types of investment strategies that people sometimes use that are more complicated, more costly, more obtuse, difficult to really understand, and so forth. We've really designed this to be, you know, user-friendly, if you will. Secondly, it provides predictable cash flow and financial liquidity every quarter when one of the securities matures. I think that's obvious from what we've shown you already, but that's really at the heart of the whole concept of the laddered portfolio, is to provide a predictable and regular amount of liquidity so that you're never very far away from the next maturity if you need the money. Thirdly, we say can be competitively bid. We didn't talk about this previously, but one thing we do is when we purchase a portfolio of securities like this, we do the equivalent of an RFP, if you will, and solicit bids from financial institutions to sell you a portfolio of treasury securities. And in doing that, that's how we make sure that you get the lowest price, or if you will, the highest yield on your portfolio, so that you're getting the best deal on your securities. And we're not padding the securities with extra profit built into the margins, which is very important because there's a lot of that goes on. Nextly, we say, the way we would set this up if you went down this path is create an account with a bank, either an existing bank that you work with, or if not, another bank of your choosing, and establish an account with the bank. And then that bank would hold in your name, in trust for you, all of these treasury securities. And only the district would have access to those securities. and whether to buy or sell or hold, whatever, it would be your money in your bank account, and then you'd receive monthly statements from the bank. You know, what's the assets, what's the transactions, what's the interest, and so forth. And we do that as a measure of security, so that you have complete control. Nobody else can buy or sell securities for you or access your funds. So that's a transparency device that we built into the structure.
And Stephen, I want to just reiterate that a little bit. That's one of the more unique concepts of this program when you compare it to other sort of more traditional investment, I guess not more traditional, but just different investment programs for municipalities. For example, with LAIF, you're sending your money to the state treasurer's office. She has an account set up for you there, but ultimately your money is held with another entity. If you work with sort of a traditional money manager or asset manager, you wire them the funds, they set up a brokerage account, and they essentially manage the funds on a day-to-day basis. In this program, no one has access to the securities, to your account, except for Mid-Peninsula. And we think that's a really important differentiator in this program.
Also, to add to that, even though we're doing a quarterly review, and Tammy knows this of the history of Wolf Hansen working with the district. If you have a problem or you have something because you feel there's an emergency situation and you need to deal with it more currently than waiting for our quarterly review, I think Tammy can attest to the fact that anytime she's had any kind of issue she needs to deal with, she gives me a call and she gets a call back very, very quickly, and we're always available to advise and to help with whatever circumstance may occur. So we would continue that under this program.
Can we go back up just to the prior page just for a moment? I think there was one more bullet, two more bullets. Yeah. So near towards the bottom there, it reads, if interest rates rise. So one other aspect of the laddered portfolio approach is that over time, as interest rates rise and fall, each ensuing reinvestment, it may be at a higher or a lower interest rate. And so gradually over time, the earnings on the entire portfolio may tend to rise or decline with interest rates. But the nature of the laddered portfolio is that it adds a lot of stability to your interest earnings, because in any one quarter, 3/4 of your portfolio is earning a fixed rate of return, and it's only reinvesting 1/4 of the portfolio. So whereas with your late investments, you see an enormous amount of volatility. Goes up one year, comes down the next year. It's very volatile. Makes it hard to budget interest income and to put that money to work, because you never know how much you're going to get. But the laddered portfolio approach is a much more stable stream of interest income. It will gradually rise and fall over time with interest rates, but at a much slower degree of volatility. And we think that's a benefit to municipalities and special districts.
That's a very key point, Stephen. Very key.
Yeah, absolutely. It's one of the underpinnings of why laddered portfolio is popular. And then the last bullet point we talk about, which we mentioned a little bit earlier, over time, the district's circumstances might change, and you may feel that it's appropriate to increase or decrease the size of your portfolio, or modify the term structure, the maturity structure of the portfolio, or even the security types in the portfolio. And as Bud has mentioned a couple of times, every quarter, when one of the securities in the portfolio matures, we'll sit down, we'll go through with you all of the elements of the portfolio and make sure that it's not, if there's a good reason to change something, that we take advantage of the opportunity and refine the portfolio so that it better suits your needs. Okay, after that, next page. We talked about this a little bit, or maybe I mentioned it just in passing, the idea of competitive bidding. We think this is a big feature of the structure that we like, going out and soliciting bids to make sure that you get the best price you can on your securities. And for that purpose, we use a bidding agent, or what's in the industry called a registered investment advisor. They carry the licenses and the expertise to go out there and bid these securities. And there's a firm that we work with that we think does a very good job, and we would work with them to structure the bidding process so that it produces the right result for the district. After that,
Next page, I think we go into, there we go. Rob, why don't you go over the various services that we would provide under this program?
Great. So thanks, Stephen. I'll take over from here. In a couple slides, we're going to sort of show a breakdown of the program expenses and what fees are applicable to what service provider. But before we get there, I'm going to quickly talk about what services we provide in conjunction with this program that are relevant to Mid-Peninsula. So there's about 7 or 8 sort of main services that you'll get if you decide to move forward with this program. First is we'll work with management and work with staff to help you determine an appropriate amount of funds that you'd like to invest based on your cash flow needs. The second service is to actually design the laddered portfolio that's going to go out to bid, which will specifically meet your cash flow needs, depending on when you have money you want to spend on capital improvements or other factors. The third service is we will assist in engaging the bidding agent, otherwise referred to as the RIA. And Stephen sort of alluded to this earlier, but basically what they do is they take the laddered portfolio that we design and they put together a bid list of different companies that will sell you the securities, and then they bid it competitively, and then they transfer the securities to your custody bank. The next service that comes along with this program is every quarter, about 1 month before one of the Treasury securities are to mature, we'll come and we'll meet with the district. We'll get an update on your cash flow needs, any changes to your capital improvement program, or any other cash flow concerns that exist. I'm sorry.
Rob has his assistant there barking in the background.
Yeah, someone's coming in and the dog's going crazy. The next service is that we'll monitor the performance of LAIF and any other sort of benchmark indexes that you're interested in tracking, and we'll compare that on a quarterly basis to the Treasury program to see if there's other opportunities that may have higher yields, whether that be LAIF, whether that be CDs, or anything that you're really interested in there. And then lastly, we will provide quarterly written reports that include an analysis and comparison to prior periods and to LAIF. And then, of course, any other questions or services that are in the purview of our expertise, we can provide in conjunction with this program. Anything to add on that, Butter, Stephen?
No, I did. You kind of skipped over a little bit the assist in the process of liquidating treasuries in the event that's necessary. But we have already described that earlier, but I want to reiterate again, that would be some service that we would provide if that event occurred.
Thank you. Okay. Are there any questions on this slide? Okay, seeing none.
Yeah, go ahead.
If we could move to 18, please. Okay, so here are the estimated fees and the breakdown of those fees. So the one-time upfront fees total just under $16,000. That is $10,000 for the services that we provide in designing the portfolio and arranging all of the other players and providing our municipal advice to the city as it relates to your funds. And of course, you know, we have a fiduciary duty to the district. The second fee of $5,000 is the one-time fee for the bidding agent. That's to sort of get you set up within their system, make sure that the portfolio that we designed is marketable, and then ultimately to go and bid that portfolio. There's also a small fee for setting up your account at the custodian bank. That can be a bank that you already do business with, or we could recommend a custodian bank that we believe would be a good match for this program. And then below that, we have the ongoing annual fees, be $5,000 for our services, which would include the quarterly reports and the quarterly meetings with management, as well as monitoring LAIF and the benchmark indexes, etc. The annual fees for the custodian bank are based on the amount of funds that you're holding there. It's a 1.25 basis points fee. So I believe that's 1.25% of 1% of the amount of money you have there, but subject to a $2,500 minimum. An $8 million portfolio would be subject to that minimum. And then lastly, the bidding agent, they have an ongoing annual fee of $1,000 to essentially rebid those 3-month securities each time one needs to be reinvested, but that fee's on an annual basis. Are there any questions on the fees while I'm on this slide?
Nope, I see none, so
All right,
Go
well,
ahead.
I think the final slide.
yeah, we can keep moving. Okay, so if you do want to move forward with us today, we would propose the following timeline. Next week, we would put together a contract for staff and your council to review. And we would work with staff to select a custody bank, whether that be a bank you already work with or one that we can recommend if you don't have one in mind, as well as getting Kazi set up as the bidding agent, the RIA. The second week, we would structure the laddered portfolio after discussions with management to discuss term and other cash flow needs and specifics of what you want the portfolio to do. Once we get that put together, the bidding agent will go and solicit bids from eligible bidders who will all submit bids at the same day at the same time, and then we'll evaluate which bid produces the lowest price or highest yield to the district. And then the following week, the winning bidder would deliver the portfolio of securities to your custody bank. Stephen, do you just want to touch briefly sort of on how that transfer takes place?
Yeah, so once you have the account set up with the custody bank, then you would withdraw money from your LAIF account. Presumably, you would have that money wired to your local bank account, and then from your local bank account, you would then wire that money to the custody bank. They normally need to receive the money. Ideally, they like to have the money delivered to the custody bank before we receive bids, just so that everything is, sort of nice and neat and taken care of. So that money will then be held by the custody bank. Normally, they put it into a money market fund for the week or so while they're waiting for the securities to be delivered. Once you have all the bids have been received, then you'll select the winning bid. As Rob mentioned, whichever bid produces the best result for the district, you'll award the bid to that firm. And then it usually takes about a week before they can actually deliver the securities. And then they would deliver the securities to your bank. Your bank would then authenticate those securities to make sure that they're the correct securities. And then upon receipt of the securities, they would then release the $5 million or $8 million, whatever the amount was, to the winning bidder and pay for the securities. But they would only release the money once they had ascertained that the securities that they had been delivered were the ones that you had in fact purchased. So, we built in a few safeguards along the way to make sure that everything goes smoothly.
And then the last slide just shows our contact information so that you can contact us if you have any questions. But that essentially concludes our slide deck, and we're here to answer any questions or continue this conversation in any direction you'd like to go.
okay, very good. Yeah, we do have a question. Director Zuka, please.
Yeah, so in reading the staff report, there's the one question that came to my mind is in going from 5 to 8, we were looking at the $3 million cash reserve. And I guess my question was why that. It's all money in the same pot, I get it, but arguably there's a dotted line around this money. Why that and not the cash reserves earmarked for capital? I mean, the stuff that's earmarked for capital, to me, we probably need less immediate access to, because we've got to go build something before I need the money. And there's time involved before I have to go pay bills on capital work, as opposed to a cash reserve for cash. I might need the cash right away. So that's the first question. The second question is, because if we change it to the cash earmarked for capital, it's 4 million, not 3 million additional to the 5.
So that's a good question, Matt. And Tammy and I were talking about this, and we were just kind of throwing numbers out there. and we're just saying, look, that the easiest ones to grab is, we know that we had said we wanted to keep that $4 million just for earmark for capital, but you bring a good point. And so we said, the easiest that came to our mind, because this has happened so quickly, is we felt, if you take a look, and Monique, let's go to page 44 in the agenda, because it's kind of got the money flow, the cash flow information in the staff report.
Because, just to be honest, it's all cash reserves. Some of it's
Yeah.
earmarked.
Yeah.
We're just talking about reinvesting it. Cash is one investment.
Yeah.
We're putting it somewhere else. It's still 4 million earmarked. I guess, I sort of see this as a question of, we're trading a little bit of access and liquidity for a higher rate. Sounds like it's fairly nominal risk from an access standpoint, in terms of the time it takes to go get the money. But, if we can mitigate that somewhat also by taking the money that I probably am not going to need right away, because I got to go, like I said, we had to issue a contractor has to go build it, then we got to pay the contractor. I mean, I'll have the money by then, right? Well, we'd have that money. If I need it for cash, that's a different thing. It seems like. So we could actually mitigate that any liquidity risk even further by tossing in the 4 million that's earmarked for capital.
We were also taking a very conservative approach, because we've never done this before and didn't know exactly how the board might feel about this. So again, the options on page 44, Monique, if you go to page 44 of the agenda, it's actually, I'm sorry, page 28. I'm sorry, page 28.
I was about to say that. I think she's on 44.
Yeah, she's on 44. I saw that too. So scroll down to about the middle of the page, and you'll see how we kind of broke that out. So Tammy and I were talking about this, and if you remember at the front of what Will Panzer was saying, they were saying in June it was about 13.2 million. It's closer to 15 million. Okay, just make that clear. They're closer to 15 million, and so we just quickly put this together, saying, look, if the board wanted to do something, it would be real easy for us to say we'd recommend $5 million. We're real comfortable with that, but that's very conservative. If the board, depending on how comfortable you feel with this, you have as much as $12 million if you wanted to do that, knowing that in that laddered portfolio you're having something maturing every 90 days. And then the question is going to be, does the board want to continue to reinvest? Is the market still such that it makes sense for the district to continue to invest in these short-term U.S. Treasury notes versus, going back in the LAIF?
I mean, I guess, when I look at this, I see we're talking about half of what we actually have in cash. 15 million. Let's just say we did the recommended 8. We've still got roughly 7 sitting there in cash with different dotted lines about it. The dotted lines can get redrawn. I mean, that's just a policy issue. That's a meeting. That's a 24 hours. We can redraw lines almost, right? If we call an emergency meeting. So, but that's not what we want to do. We don't want to set ourselves up for that. But, effectively what we would have is we would have 7 million sitting there in actual cash, and then the rest of it sitting in treasuries. All of it is reserves. And I guess I go back to what I heard our advisors say tonight, and I'm saying it again to make sure A, I understand it comes out of my mouth cleanly, and then B, no one is disagreeing with me because I didn't get it right or wrong. That it's, we're slightly less liquid than LAIF, but that's why we're getting a couple of points extra interest, percentage wise. So that's the trade off that I heard. With that being said, if we end up going in after it, we're not losing that much interest. And so, I'm not seeing a whole lot of risk personally. I agree with Kathy. I'm, conservative on this, on the public's money. But like I said, we can mitigate that even further by leaving our cash in cash, our board, like the 3 million, because that's what we would need to pay a surprise bill that comes in the door that's due in 30 days. We're going to have a lot longer than that if we're talking about what's earmarked for capital without having to change policy.
Yeah, so then you're talking about maybe 8 to 9
60,
million
90 days or whatever. Yeah, $9 million. But then, I mean, even if it was the same number, it seems to me we're going after the wrong. We're talking about the wrong dash line going into the treasuries. It ought to be the earmark for capital, not the actual cash.
And the way I looked at it, Sorry, the way I would look at it, I just wanted to respond to that. And the way when we penciled this out, Matt, is just that, the budget, the capital budget's an approved document. It's a policy document, right? And it shows that $4 million will be used, right, of pay-go money, which is why I just put it up there to be conservative, to say you've got an approved budget out there. It says there'll be $4 of pay-go money blended with the COP dollar to do the 22-23 CIP.
Okay,
That's
but
the reason why I
then if
put
we're
that.
budgeting it, that's no longer reserves, I guess is what I'm saying. If it's
So that's
budgeted,
why it's earmarked for capital. Yeah. So we should have said budgeted, but it is
budgeted.
budgeted. It's in
Okay.
the approved budget. Okay. So it went to the top of the list. And that's the way I looked at it. It's like, we know Harbor's about to be bid out, and we know the plans are almost done, that Mott McDonald's working on. So that project could be one that comes to fruition, and we're coming to the board and getting it.
Okay. Yeah, then scratch everything I just said, because I read that line and it's, if it's a reserve, it's a reserve. If it's budgeted money,
We should have said budgeted. I'm sorry that we didn't catch that.
Okay.
Yeah.
all right, then never mind.
Yeah.
I'm
I lower my
sorry.
hand.
I'm sorry, I just looked
Well,
at the
this-
word and I did review the report, but I guess we should have had that it isn't an approved budget.
If
Okay.
it helps, Matt, this 5 and the 8, I mean, we're tossing out numbers, and I know that we have 5 people on the board that are probably on the conservative side, all of us. But when we were discussing this during the finance committee meeting, I mean, I was very comfortable with 5. When it started getting to 8, I said, not to exceed 8, and the 5 and the 8 appeared on the report here. Only because, to me, if it's budgeted, it's spoken for.
Right.
And I didn't want to go out too much on a limb, because I still am dealing. If it was my money, I would probably go a lot more, but it's not my money. So I wanted to be a very good steward with the people's money. And that's why I personally said, and I have to admit it, I was the one that said not to exceed 8. So that's where the 5 and the 8 came. So
Thank you for that, Louis. And I guess maybe one other question, and I'll put myself back on mute, is if we decide as we go through that first round that we want to up, so the first 3-month note becomes available, we could always then decide that we want to do more than the 1 1.25, and we could up that to whatever would get us to 8 over the next year. So this isn't a done deal. We just would be kind of locked in. I mean, theoretically, we do whatever we want, even with the remainder, but you could just cycle it in. Hey, if we like this, we slowly ratchet it up to 8,
anytime,
and then we could
anytime,
ratchet it
correct,
out down to 5, and we could kind of go up and down.
correct.
Okay.
This is Bud. Two thoughts on that. Absolutely. That's why the program has the flexibility that it does. I think it's irrelevant now based on what you just said, but we just recently, actually it was earlier today, working with a city that has a major project coming up where they have over $40 million set aside for capital improvements. And they like this program so much that what they decided they would do is put the capital money in there to get that 4% or so return, because they don't think they're actually going to need the money until mid-24 or 25.
That's a good
And
point.
they are planning on possibly borrowing money at that point, depending on where rates are. And their view was we could earn $1 million or $1.5 million in money that we wouldn't be earning if we stayed where we were, and use that for debt service going forward when we do a project. And I know you do have some thought, it was in your rate study, of possibly doing it whenever the appropriate time is, a $10 to $15 million project. But if you've already got it earmarked in such a way that that's not convenient, that doesn't, but it's maybe something you could consider.
And let me just restate that in my words, because this is the way, and sorry, Brian, I'll turn it over to you. We could take that 4 million, stick it into a 6-month note, because we know we're going to start needing to pay out bills no sooner than 6 months. And then, we could put the entire 8 in, and then just time the exit of the 4 based upon when we think we actually have to start paying bills.
Yeah.
We're going to hire you onto our team to help us structure. That's a very, very.
No,
good
I just make it sound good. I just make it sound good, and then I'm out of here. I don't want to do the actual work.
No.
Thank you.
But yes, that's
Okay.
certainly, that's the flexibility of the program. You certainly could do that.
Yeah, okay. Let me go for a second, and then I know Brian has his hand up, but I thought I saw Kirk on. Do we turn it over to Kirk now, or shall we continue on?
You can turn it over to Kirk. He's here.
Kirk?
His audio, he's muted.
All right. Brian.
I'm just
Okay.
signing in.
All
I
right.
was listening on the phone.
All right. So can you take over or?
Sure. Whoops.
Need to
You
mute
you
Hang
have a
on, I'm
lot
kind
of
of
echoing going
feedback
on.
loop going on. Okay.
Okay.
So, Brian, you had a question?
Yeah, maybe a couple, and maybe this would be interpreted as more aggressive and less conservative. But I think you're conservative when you're avoiding risk, and I don't see what the risk is. So I would be tempted to max out on switching over from LAIF to this laddered approach. Maybe the only risk I can see is there's something we don't understand or nobody understands, including our consultants, and there's a risk that we haven't talked about. We do understand LAIF. This is new, so maybe we don't understand it. That to me is the extent of the risk. I don't know if our consultants want to have any.
Yeah,
opinion.
I would say basically I agree with you, but I think good advice, and we have a fiduciary responsibility to always give you what we think is the best in your best interest. I don't think we would recommend going full bore into this at this point, even though I think the risk is very minimal. Just good business would say that I don't know how much you're talking about. You certainly wouldn't want to keep a reasonable amount in LAIF or whatever other current bank account you have, just so you don't even have to deal with the hassle of having to sell. Even though it's very easy to do, it's not quite as easy as just writing a check out of an account. So, you'd always want to have some of that in your regular accounts.
So I guess the question is, what is some? Is it 1 million? Is it 4 million?
That's something we would plan on having that discussion
Yeah.
with the staff, but I would say certainly something like 3 million would be a reasonable. If you have 15 million, I would not put more than 12 million into the program at this point until you're comfortable with the process. I think go through a process where you see the quarterly updates, see the reinvestment after 3 months, see what's involved, and then have a comfort level, and then you can decide based on the rates what the best move is as to how much. But I would certainly keep 3 million in your either in LAIF or whatever other local bank that you use, or money market situation.
I would agree with that as well. We'd have something, I think, that we could talk to Sheldon, our district treasurer, have a conversation, and then have a conversation internally of what we see our bills are. We've just been talking about that because we try to maintain a certain amount of money in our checking account to pay for payroll, and we've got our big water bill every month as a PUC, so that we're always managing that cash flow. So we're managing the money going back and forth between what we have in our bank needs daily versus what's going into LAIF. So we'd want to take a look at that if the board is that comfortable and wanted to put more into U.S. Treasuries in the LAIF.
And then per Matt and Tammy's discussion, the cash reserves for capital might mean we don't have 15 million, we have something less, although we also might not need that money in the next 3 to 6 months for capital. So it might be able to get better interest on it.
Yeah.
That's right.
By the way, I like your idea that you suggested that for that portion, you might want to have that in more than right now, and Stephen, correct me if that fouls up the concept, but if you're adding more than the 8 million and that's where the money is coming from, you would put that into more of the 3 month and 6 month than you would for the rest of it.
And that's just my opinion. I don't know what the rest of the board.
Oh, but I mean, I think that does make sense based on what you're saying. That's the kind of thing that will be developed in talking to the staff of how you specifically need needs that are different than maybe another agency would be. And we can tailor the program to accommodate that.
And then I assume we'd have to adjust some policies if we're going to do some of this. I don't know if we can do that today.
I don't think so. Did we looked at the investment policy, Rob, right?
Correct. We looked at the investment policy, and all
Yeah.
that we need to institute this program is approval from the board to invest in treasury securities, which are included in your investment policy as a suitable investment if you have board approval.
That's right.
Yeah, you don't have any limits as to the terms or the amount. that you're putting in,
Well, I
as long
think
as it is in treasuries.
it's in treasuries, and I think it says in there, it's got to be 2 years or less. If you go back to that
Oh,
page
okay, great.
44,
Okay, right.
page 44 of the board
Exactly.
investment policy back in 2011.
Yeah.
In 7A, it talked about it being 2 years or less. What did I change?
Yeah,
it
well,
to 2 years?
our program is set on for 2 years or less, so that's right. This would just be the shorter end, having more in a 3 or 6 month, having more in, let's say, 6 months than you have just in the 3 month, because you know you might need the money during that period. So,
Okay, and
but
finally,
those are the things we could work out.
our resolution on page 30, the one thing I'm at the bottom, one thing I'm a little uncomfortable about is it suggests a cash transfer in a range of 5 to 8 million. I kind of feel like we don't want a range. We should be telling staff.
And we can, yeah, so whatever the board decides that they want to do, if you want to put a specific number, we would amend the resolution to put that specific number. We just didn't know if the board is even going to like this. So we said, well, we'll just put something in there recommending a range, let the board have the discussion. And if they like it, if they have a particular number, we can edit the resolution to put the particular number in there.
Absolutely.
Okay, thanks. So if the board wants to do 5 million, that's great. If they want to do 8 million or maybe even a little more than that, sounds
Or if
great.
you want to do 6 million or 7 million, whatever amount.
Whatever number you want, and that's an alternative. We put 4 different alternatives. One is 5, one is 8, or one is another number that the board's comfortable with, or the other is just not do anything at all.
But we wouldn't be a good board if we just stuck to the alternatives. So,
Thank you.
Okay, Kathy, you have your hand up.
Yes, I just wanted to kind of put in my 2 cents in terms of the risk of the money. I'll still go back to that. I'm a little more conservative, especially because this is the people's money and not my personal bank account. And mostly because it's not something that the district has done before. And to Matt's point, we can start maybe on the more conservative end, and we can always increase. We meet quarterly with the advisors, so I think we can increase if we're seeing the return is really good and we're more comfortable with it. The question I asked Rena when I met with him was, how many other, it sounds like such an amazing opportunity. How many other districts are doing this? And, I get a little, gun shy about, well, is this too good to be true? Because it just seems like a no-brainer. So I think the gut in me is trying to be a little more conservative, because it seems like such a thing that we should do, but at the same time, it's not something that the district has had any experience with.
I can take this one. So there are hundreds, if not thousands, of municipalities, special districts, and other public agencies in California that invest in U.S. Treasuries either directly or indirectly. So that aspect of the program is extremely, extremely common. As a member of LAIF currently, you have exposure to short-term U.S. Treasuries. As far as this program specifically, this opportunity did not become so drastic when compared to the alternatives until June or July of this year. That's really when that wide differential,
The interest rate started changing.
Exactly.
Right.
That wide change in interest rates really made this program attractive. When we first started meeting with the finance committee, we had 2 other public agencies that were fully signed up for the program. Their portfolio was bid out and the securities were transferred to their bank account. We're in the process of talking to another dozen or so public agencies, all who seem very, very interested in this program. And we're getting new signups almost every day from new clients and existing clients that are in a similar position to you are right now, some a little bit further along in the process, some a little bit further behind in the process, but we're yet to meet with a public agency yet that doesn't think this is a terrific program.
Okay, thank you. No, it does sound like a terrific program. I just was pretty surprised that it's not something that we've done before, but understanding that the interest rate spike has just recently happened. I appreciate your answer. Thank you.
Let's see, Matt is up next.
So in the interest of moving this along, I have a proposal that I'll toss out there if other people want to take a shot at it. My thought is that if we move forward on the 5 million and with sort of an A and a B, more forward on the 5 million, and then the B is what do we do with the 4 and what do we need to for paying off construction bills as they come in. So really, as proposed, it would be on the 5, unless somehow the 4 gets wrapped into the 5, but that seems a little complicated. Maybe more like a ladder approach for the 5 million as proposed, and then some sort of investment strategy for the 4 million that's going to get spent as capital budget. So if we're not going to start spending bills for 6 months, and we're going to pay that 4 million out over a year, what do we do with that 4 million? To me, it has to have sort of a separate thought process to it than just, tied into the latter elements of it. But I'm comfortable putting both those pots into this concept personally, as long as we're managing them, so that we're paying close attention to when we need the money coming back in for the capital.
Again, the flexibility of this program is we certainly could do 2 separate structures, one to accommodate the capital improvement money and one for your general reserve money that is under the basics of our program. So that would certainly be no problem. And there would be no extra cost that would all be included in our fee. Our fee doesn't change by the size or as long as it's the same basic program.
Right.
That would be
and the only reason I say break it up is because the rationale changes depending on what the need. We have a definite need for having that 4 back at a certain rate at a certain time.
Absolutely.
It's different than a cycling process that you're talking about, which kind of is structured quarterly and yada yada yada. But it's largely structured quarterly because the 3-month bond is the minimum amount of time, right?
Yes.
So we might be able to figure out a different structure for the 4 million where we might not need it for a year. I don't know. I mean, Rena, you guys tell us when is it going to come in?
I'm thinking, Matt, that as Tammy was saying, the harbor project, we're ready to go out to bid. It's going out to bid actually, shortly. So it just depends on, because what we've been running into, and you're probably experiencing this where you're working at now, contractors are having just supply chain issues trying to get materials. And so that could, delay the capital project. So I'm thinking, geez, if the board wanted to take that $4 million that's budgeted for capital and put it in a 6-month treasury, that's probably very conservative, and we probably wouldn't start paying any bills until we get to that 6-month period. And even then, we still have some cash. If we don't put all of it into it, we still have some cash that we could use to pay the bills until those treasuries mature. And then we'd be coming back to the board and say, okay, look, the 4 million's done because it's now got to be used to pay the pay-go.
Right. So I guess I'll stop there because there's 4 other board members that have to weigh in on whether or not they think I'm an idiot or not still, and whether or not they agree with that as an idea.
Okay, Louis, you were up next.
Yes, thank you. During the beginning of the conversation and during the finance committee discussions that we had, I was kind of leaning towards the 5 and the 6. And after this conversation today, I'm gonna have to say that I am comfortable with 8 as well. And the reason being is that sure we are, we need to be stewards of the money, people's money and all that, but we are also responsible to not miss out on opportunities like this. And I think this is an opportunity, and by going with 8, I don't think that we are going to be jeopardizing our position financially in the case of capital projects. So I'm comfortable either way, even with 8. That's it.
Okay, Brian?
Well, Matt asked us to weigh in on 2 questions. One is whether he's an idiot, and the other is whether he has a good idea. No, he's not an idiot. I do think it's a good idea as to both for yes, so it's done well for both. I think since we tend to like to move unanimously, I'm willing to do whatever, even if it's just 5 million, maybe what all 5 of us are willing to do, with the idea that we can come back in 6 months and look at this again and see if we want to up the amount. So I'd go for 9. It sounds like Lewis is going for 8. I'm not sure where Kirk and Kathy are going. So that any of that is fine with me.
Okay. I haven't weighed in yet, so I will now. And I guess I would favor the 8. I don't see any reason to wait. And, you know, we're going to reevaluate it in 3-month and 6-month timeframes. So once we have a good idea as to what the current contracts are, we can say, oh, we've got to scale it back. We need a little bit more money out if we need to. So we've got a lot of money there. We're still going to have, what, 5 or more, more than that. We're going to have more like $7 million sitting in the bank. So I don't see a reason to stay with 5 and not move to 8. Kathy.
Okay, I'll answer the questions also. Yeah, Matt, you are definitely not an idiot. Yeah, I, in the interest of being collaborative, I'm more comfortable after the discussion. It's just how I feel personally about things. So, given that we'll still have a significant amount of money elsewhere, I'm comfortable going with Matt's idea of the 9.
Do we have?
And I just wanted to add one last thing to that hasn't been mentioned, and that is, you know, we're aware of several developments that are still out there. Kat and Rena have feverishly been working on. And so there are expected capacity fees to be coming in, probably another $500,000 that we did not budget in this fiscal year. The earnings in LAIF were budgeted very conservatively in last year's budget that's been approved by the board, and we've already seen them be quadruple more than what was budgeted. So that's the reason why staff went along with that 5 to 8. We're very comfortable with the 8 million, and we just wanted to make sure that, you know, there was that range so that if the board did say, hey, look, we really want to take baby steps, we want to do the 5. But I just wanted to echo again that I believe, and Rena stated it, that we're confident that we could do with the $8 million. We also have a rate study coming to a conclusion. Our capacity fee charge is coming to a conclusion. All of these things are going to be presented in these next several months that as financially and the position that we're in, the district's in, it's a very stable one. So I just wanted to add my last 2 cents. Thank you.
So I guess we have sort of a separation between people who are talking 9, some people who are talking 8. Is that where we are? Basically, we'll flip a coin between those 2.
I think it's not that much different, you know, and I'm willing to move, you know, with the 8 if there is a second. The recommendation from the staff was also 8. So,
And sorry, Louis, just to be clear, 8. When I said the 2 numbers that I tossed out there were 9, but it was 2 concepts, right? It was 5 on this sort of ladder quarterly system, and then secondly was a plan for the 4 that we know we need to spend, that we need for capital, not a ladder, not a whatever, like, but a separate plan, an A and a B. So the total's 9. Are you saying instead of 5, make that an 8? Or are you talking about the total?
no, I'm talking about instead of the 5, make it the 8.
And then still do the 4.
Still, correct. Yeah.
Okay.
Because we have the 7, right? We have the 7 available.
So now you're talking 12. If you're talking 8 plus the 4, the capital, so you got 2 different. Now you're talking 8 plus 4, which is 12. Is that what I'm hearing?
Yeah, that wasn't my thought. But you know, I was talking a total of 9. Can you pull up that table on the screen, Rena, just so we can look at the numbers? I'm looking at it on my
Monique,
staff report.
page 28 of the agenda, Monique.
Okay, so Rena, when the staff proposed 8. They weren't talking about 8 and 4. They were talking about 8.
So if you look on page 28, and she's got it right there, so you see the bold numbers, the board cash reserve policy, the $3 million, and then the available after we've subtracted out any kind of monies for a potential debt issuance, you know, the 3.5 million. So there's the 3 and there's a 5 bold. That's where that 8 comes from. But what Matt and Tammy were talking about is up above the $4 million. That's a budgeted number, right? That's a budget number for pay-go capital this fiscal year. And we're close to, you know, putting out to bid a couple of projects. And depending on, you know, when we get our bids back and when contractors can start because of supply chain issues, I can see that even at $4 million, you know, we're not going to be spending it for at least 6 months. By the time we go through the process and then come to the board to award it, and then the contractor starts putting in all the submittals for all of his materials, and he's out there ordering his materials, I mean, I wouldn't be surprised that we don't start a project that we award in October, November. We don't start that till, you know, January, February, and that's dependent upon what the supply chain looks like for them to get materials. And so that means that they might start construction in, you know, January, February, you know, and then we might not get a bill until March to pay, you know, so that's 6 months out right now.
So my just to be clear, my thing was leave the 3 million that's bolded in the bank as cash. Take the 5 into treasuries. That was that's A. Plan B is what are we going to do with the 4 that is going to get spent, but we know we have time. You know, there's no, you know, maybe you put half of it into 3 months and the other half of it into 6. I don't know. Or you put $1 million into 3 and you put come up with a plan for that 4 to maximize the return on investment until you need it. That was sort of B. And then the A was put the 5 million in, and now we're leaving the actual cash in cash. And so, but we're still putting over the short haul 9 million into treasuries. So that's where the 9 came from, Louis, I guess.
Correct. I perfectly understand.
Okay.
And what I was going by what we were presented on the report. And basically I was looking at alternative. I wasn't looking at alternative 2, but after the conversation today, I'm more leaning towards alternative 2. And that is exactly what I was looking at. And if I had to make a motion, it will be alternative 2 right there. That's all.
Louis, could I offer a thought here? In listening to you, particularly on the 4 million, and Rena, when you were talking about you might need it in 6, but the interesting thing about, and this is the kind of advice we would be giving when we get ready to finalize, we would take a look at the various yields that are available. And the yield curve is, and I don't want to get too technical here, is very flat in the short end, which means that the 3-year and the 6-year are very close in yield. So you're not giving up very much interest by going part of it into the 3-month, just in case you would need that money faster. And then the balance you would go into the 6-month, you would be giving up maybe 3 or 4 or 5 basis points in yield, very, very small. You'd be getting in the 3.5 range versus 3.55, something like that. So we would take a look at that. So that could give you a little more assurance for anybody that's a little uncomfortable that you would need that capital money faster than 6 months. You would put part in 3 and part in 6.
Okay, so how are we going to phrase this? Because
Brian has a question.
Brian?
Yeah, I do have a question on alternative 2. Our consultants have said they recommend we do have $3 million in cash that we can actually use at any time. Can we do that if we go with alternative 2? Because that 4 million is for cash reserves for capital. It's kind of available right now, but we're going to need it at some point. And then there's that 3.5 million for debt issuance. Where's the 3 million that we want to leave in cash if we go with alternative 2?
I mean, if you just take a total of 9 million away from the 15 million, Brian, there's a $6 million balance in cash reserves. I mean, just like Matt had mentioned earlier, nothing is like, established about what is to be spent on, except for what you approved in your budget, the 4 million.
Right.
Agreed that you can take that 4 million and leverage it, which is what we're talking about doing. And I love that idea. I really do, because I'm progressive and I like to see the money make money that we have. So I guess I'm trying to understand why we don't just take the 9 million and put it in the ladder and cash it out if we need it. I mean, we're going to have 6 million left in the bank. We've got about 6 or 7 million left in COPs. And so we have cash and we have project money. The liquidability of LAIF, like Bud and Rob and Stephen mentioned, is very simple. Within 24 hours, we make a transfer from LAIF into our bank account. Boom, it's there. This might take a few days to be liquidable, but it's still going to be liquidable if we need it. So I'm just trying to understand why we don't just take the 9 and put it in the ladder and cash out if we need it.
Yeah, I'd be okay with that.
Yeah, I mean, it's just simple. And once you give that authority to Rena as the interim GM, then we come back and we tell you guys the package that we structured and say, here's what we did with it. Here's what it looks like based on the input we got tonight and the direction.
Yeah, I mean, if you guys came back with that recommendation that it's the ladder, right?
Yeah.
My only point is that you're going to need the money on the 4 for different reasons and a different pace than the than the 5. And so as long as you think you can see those different criteria in the ladder, I'll leave it. I guess I would almost, it seems to me, it makes more intuitive sense to me. It's all to intuition. They just have two different criteria.
Have
We
a
can
$5 million
certainly-
ladder portfolio
Right.
and then have another one for the $4 million. You know, maybe it's 3 months, maybe it's 6 months, maybe it's another ladder 3 and 6 months.
Right.
For that $4 million.
Right.
All of that would be available. All of
Okay.
that you could structure. That's the beauty of this program, is the full variability of the structure that you can utilize at the same cost and with pretty much the same, because the yield differentials are not that great. On the shorter end, you're still getting a great return, whether it's 3, 6, or 9, all the way up to a year. So that's certainly available any way that fits your needs.
I think that's a good way to do it. Have a $5 million laddered portfolio that we've heard. You know, we got 4 different rungs on the ladder, and then take the budgeted cash reserves for capital, that $4 million, and put it something that's the same as a laddered one, but maybe it's a 3-month and a 6-month type thing.
Perfect.
I don't know how the board feels about that. And then again, we're going to be getting information every quarter and talking with Wolf Hansen and see how it's going. And then, you know, we can make a decision and come back to the board and say, hey, you know, it's time to pull it out because we've got some capital monies we've got to spend now, and it's going to be coming out of the pay-go, or there may be the position to put a portion of it again for another 3 months and another short term, keep making money on the money.
I love it. I did recommend to Brenna that we use our BNY account. We have an established relationship with them.
Yeah.
They're super easy to work with, and we've already got templates set up for transferring in and out.
Yeah.
Rather than our Wells Fargo account.
So I think we're sort of getting to a consensus, and I think the motion could be to say, okay, we're going to go with 9. We're going to do it in a laddered fashion, and we'll see how that works for the first 3 months, and whether we'll then have a better idea what these contracts are going to look like, because they may not have costs for 3 months, 6 months, 9 months. Old County is going to be a longer term process.
Well, and that's coming out of the COPs, Kurt, the certificates of participation. Not paid.
Okay. Yeah. So what would be the next project after Harbor on the pay-go?
The PAYGO, the other one would be one that's, we call it the Decoven utilization, which is some pipeline improvements up by the Decoven tanks, but it's out in the streets surrounding the Decoven tanks on Lincoln and Newlands and Decoven. And that's something right now that an engineer is working on. They're probably at maybe a 50 to 65% plans.
So they might go to bid during the summer or something like that.
If we can get the engineering done before the end of this calendar year, we're going to put it out to bid.
Okay.
And that one is, Jubin, is that like a $1.5 million project? Something like
Yeah,
that?
it's currently scheduled to go out to bid late winter, early spring of next year, and it's about a $1.5 to $2 million project.
Mm-hmm. So it sounds like the 4 is really going to get spent in 12 months. It really is a realistic budget. And so, yes, we can get some money upfront by buying some treasuries early on.
Yeah, earn some more interest on that $4 million and versus LAIF.
Okay. So could we agree on a $9 million laddered portfolio? Louis, you have a question or do you have a comment?
Yeah, just two questions. One, Rena, would you be comfortable with the way, this is gonna go now with the 5 and the 4, number one? And secondly, if we're gonna vote on a resolution, how is this going to be written? The resolution has to be rewritten?
Right, that's right. It's got to be rewritten and rewritten at the very top, right on page 29. It's no longer going to say $5 to $8 million not to exceed. It would have to be rewritten. And it depends again, we're talking about a $5 million laddered portfolio that goes over a 12-month period, right? And then we're talking about a $4 million laddered portfolio that may be a 3-month and a 6-month ladder.
Well, it sounds like the ladder would still be more like a year because that's what the capital budget timeframe really is.
Well, we're probably going to have some expenses, Kurt, PAYGO expenses, probably in February or March.
Okay. So Rena, we're not going to vote on it this time. It's going to be rewritten.
We could well, Catherine, we can amend the resolution right now, can't we? And then the board adopt the resolution. We can.
Yes, that's right.
We can do that. We just have to agree on what that language is going to be that we're going to place in here.
Okay. Who's going to take a stab at it?
Well, we can take a stab at it. Just we want to make sure everybody's on the same page.
Well, I'll take a stab at what I meant by the whole thing, and then where I think we ended up, which is, item number 1 goes authorizing $9 million cash transfer, but it's in 2. We're basically a $5 million ladder portfolio, for the lack of a better term, plus a second. I think this second part is TBD though, because we don't know what that looks like, which is what are we going to do with the $4 million in capital? So we could just another option is we could just authorize alternative 2 at $5 million and say, come back next month with the plan for the capital. And what you want to do on the 4, if that's easier. So we just simplify this, call it 5 million, and then we'll do another resolution next year on how we invest the treasury on the 4 million that's going in the capital.
You just lose a month's interest on the 4 million.
Or it's 9. I mean, I guess I don't know how quickly it's going to get transferred and we're going to start making interest on it. But yeah, arguably we're going to lose a month's interest.
So it's a total of $9 million, and we're going to have a $5 million laddered portfolio for a 12-month period, right? And then B, we're going to have a $4 million laddered portfolio, but for how long do we want it? Well, I'm saying that we go maybe a 3-month and then a 6-month laddered portfolio.
Well, I think we're guessing at this point because we don't, well, just because. Unless you know for sure when the money is gonna, off the top of your head, is gonna really be necessary. But 3 and 6 is sort of some combination thereof.
we would still have the $3 million cash right in the bank that we're not touching. And then we still have that $3.5 million that we're talking about, would be part of potentially some sort of future debt issuance. And we're not even anywhere near that discussion level with the board yet. So there's $6.5 million cash sitting in LAIF that we could get access to if we needed it to pay for pay-go capital or to pay our regular bills. Plus, we've got just our regular cash flow from our customers.
President Wheeler and Rena, sorry, I can't figure out how to raise my hand, but I have a question that might help clarify the drafting process.
Yes.
If you could scroll down to the resolution. Thank you. So the first resolved section here, 1, is currently structured. So you have 5 to 8 million. There's no discussion of a ladder, but we talk about U.S. Treasuries for an initial period not to exceed 2 years. And this is also a question for Bud's team. Would it, if you split this and you said 5 million and kept it as is for 2 years, and then you added in another action item, which would say 4 million, use the exact same language, but then say 6 months.
6 months.
We're not, I would still use that not to exceed, because we do that all the time in bond issues. Not to exceed simply protects the board or city council that you're not going to go issue more than what they're comfortable with. You can always issue less. You have a not to exceed term. You can always issue a shorter if that's the way the requirements are based on your needs. So
Okay.
I would phrase it in those not to exceed numbers, both as to term, well, basically as to term and to amount.
Would you agree, Bud, that would it make sense and give you the authority that Rena and the rest of the team wants to move forward with, assuming the rest of the board signs off on it? If you split this and do say not to exceed 8 million and so on and so forth, leave the rest of that first one the same, and then put in a new second one that says not to exceed 4 million, and also for an initial period not to exceed 6 months.
Well, I would put 1 year, and then you could do 6 months or 9 months, whatever, or 3 months.
As long as you
But
put not to
just
exceed in there.
Just do the
Yeah.
not to exceed. So absolutely. Actually, I think it's clearer and it really shows the intent of the board more concisely. So I like that language, as long as the attorney here likes it too. So
Brian, you had your hand up.
Yeah, all that sounds fine. I like this new suggestion with a new number 2.
So
Yeah,
wait
the
a minute.
wording sounds good.
I was just gonna say, so the first one, it's $5 million, not to exceed the $5 million for 2 years. And then the second step would be $4 million, not to exceed 4 million and not to exceed 1 year,
1 year,
right?
yes, correct.
Okay. And then so also inside the resolution, so Monique, scroll down to the next page, page 30, the top, there's a whereas up there. So we have to change this as well, right? We got to get rid of the 5 to 8, I think, and probably have basically kind of what we say in the top at the beginning, the description of the action is going to be here as well. And then at the bottom of page 30, where it says now, therefore, the board resolves to do this, again, the same thing. We're going to have the action items. There's going to be a cash transfer of $5 million, not to exceed $5 million, cash reserve, blah, 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 not to exceed 2 years. And then another one that says $4 million, not to exceed $4 million for a period of time, not to exceed 1 year. So those would be the amendments that I see to the resolution. Does that make sense to everybody?
Perfect.
So but we're ending up that there is no, what do I want to call it? There is no actual stopping point on these, is there?
Yes, as these mature, because we're doing a laddered portfolio, every 3 months you look at whether you're going to be reinvesting or not, or stopping the program. You could always decide that once the full ladder matures, that you stop it and go into LAIF, or you continue it. That's the beauty of it. You have that flexibility every 90 days.
So that says if we have the $5 million in a 2-year ladder,
right?
After 2 years, we have to have a new resolution to continue it further.
I would,
But the ladder time frame was just a limitation on what sort of securities we were buying.
It also is, I believe, it's a limit of the maximum term. Stephen, how have you handled that in the past? What did you get that reinvestment a resolution, or do you just continue the project until it's canceled?
Remember, Rena mentioned earlier that our investment policy limits investments for 2 years.
That's
So you would
correct.
have to
That's
go
correct.
back
Yeah,
to the
you'd have
board.
that answers the question.
I think it's 5 years. I was just
Yeah.
looking at the investment policy. I believe it limits it to 5 years.
Does it?
I thought I saw two. I had to,
Yeah,
You might be looking at different sections
yeah, it
though.
might have been.
Rob, we were also looking at that other city that has a 5 years, so you may have conflated that.
I think it may actually be 5 years. I think it's
Oh,
in
great.
subpart 4.
Okay,
Is it
good.
part 4?
Yeah, on page 2.
Yeah.
If you wanted to pull it up.
Page 2, page 43.
Yeah,
Bonnie.
sorry. 43 of the whole.
Yeah, terms of investment. Okay, I'm sorry. It says 5 years.
Okay. So as long as you keep it where the total doesn't go more than 5 years from the time you're starting, you could. I don't know if you'd have to come back again. You could decide not to continue, but if you wanted to continue, you should be able to continue.
Subpart 4. Yeah, there you go.
Right there at the very end.
I do think, just for clarity, the way that I'm currently reading the resolution, at least, is that you would have to take action after 2 years. So if you wanted to change that, I would suggest specifying that.
Well, I think we kept it at 2 years because during the discussion with the finance committee and so on, we said these are short-term treasuries. And so that 2 year period came up then, right? And anything longer than you started talking about them being, bonds or long-term bonds, Bud.
Yes, and more, and there's probably going to be more volatility in those longer maturities. I like the idea of keeping this into the short
2 years.
maturities, no more than 2 years. And I probably a comfort zone for us as advisors if it comes back to the board for approval, if you're going to do anything beyond the 2 years.
Yeah.
Then shouldn't we just say that the initial period that we're talking about is for treasury maturities rather than?
No, because you're doing a variety of maturities but just we know that not to go longer than 2 years from the start of the program without your approval.
But then
right
we don't.
Now we're investing in 1 year and rolling every 3 months. So that continues
Right.
out through the second year.
So the ladder that we're starting out with is equal blocks, basically. But we may want something different for parts of it.
Correct.
Going
As we
forward.
do our review, yes.
Right. Okay. So the equal portion of it is really just for the initial period.
Right.
Yes. Yeah, then after that, they could go into a 12-month window. So now you started them staggered, they're going to continue staggered until we stop it.
Right.
Right. Okay. Then it does sound like we should have a second block for the 4.
Right. So resolution 23 would have authorizing $5 million, not to exceed $5 million cash transfer from MPWD LAIF reserves to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for a laddered portfolio, an initial period not to exceed 10 years to exceed a higher investment yield, and $4 million, not to exceed $4 million cash transfer from MPWD LAIF reserves to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for an initial period. I forgot the laddered portfolio in there as well. To initial period not to exceed 1 year to secure a higher investment yield, and 3, $25,000 for related investment purchase fees and professional fees, and 4, the interim general manager to execute all necessary documents related to MPWD's investment in U.S. Treasuries. And then we make similar amendments to the resolution on page 30 in the in the agenda package to correct that. So there'd probably be another whereas that talks about the $4 million ladder portfolio. And then same thing on the bottom of page 30 under the now therefore be resolved, there would be a second one that talks about the $4 million ladder portfolio not to exceed a year.
Perfect.
Okay.
The board, you get that, you understand that, and you're comfortable with that?
Anyone have concerns about that? Brian, you got your hand up?
Yeah, I just think if we're going to add a whereas, then we need to spell it out now because we're passing the resolution now. Although I don't know if we really need to add another whereas. Outside of that, everything has been spelled out by what Rena said.
If you scroll up to the whereas where it talks about the 5 to 8.
Yeah, just a little bit higher, Monique.
Thank you.
That one right there, yeah.
Yeah, I would envision there would be one following that 5 to 8. So that 5 to 8 would then be changed to 5. So you'd strike the 8.
Right.
And then there would be an same language
Right.
following that, except it would be 4 million and 1 year.
But that would be another whereas or within this one?
Yeah, I would do it as another whereas,
Okay.
just
Yeah.
to replicate the structure.
Right. That's what I was thinking too.
Sounds good.
Then we don't need we don't need to have a second version of the next whereas. Do we?
So on right here where we're at, where Monique's got the staff report, we would change that to get rid of the $8 million and leave the rest of it in there. Because it talks about the laddered portfolio, it talks about the 2-year short-term investments. And then we would add another whereas right below it that would say the same thing, other than now it's talking about a $4 million laddered portfolio investment account for up to a 1-year short-term investment.
Okay, then we don't have to change the following whereas.
The following one stays there. The laddered portfolio or 3, 6, 9 month, 12-month maturities.
I think Director Wheeler is raising the question because it refers to not to exceed 2 years.
Oh, okay.
But if the whereas we insert looks at 1 year, then having the not to exceed in the following whereas doesn't affect anything.
Or you just end it that whereas paragraph after the word investments and strike the language from 4 terms not to exceed 2 years to the very end of that.
Right.
And that way, at least you're just clear on what a laddered portfolio investment is. And you've already made the clarifications in the preceding 2 paragraphs with regard to the terms and the amounts.
Or perhaps, I'm not sure that we have, Tammy, I agree. I like that. Do we say though, not to exceed in the previous, maybe we say for the terms specified above until such time as Mid-Penn decides to invest its cash reserves.
There you go.
Yeah, that would.
Yeah. Yep. That's transparent.
Yeah.
Catherine, I'll work with you tomorrow to get that.
Yeah, absolutely. Happy to help with that. Did that make sense to the board?
I think I understood.
Thank you for raising that. I agree. I think we should clarify that reference to not to exceed 2 years there.
Can I make one observation? BNY Mellon, I believe they have a $3,500 minimum fee to serve as custody agent. We had assumed a $2,500 minimum fee in our budget with the idea that there are other banks. And so I would suggest that it might be appropriate to add a small additional amount to the budget for expenditures to allow for the higher fee charged by BNY Mellon.
Yeah, because you know, this is, but fees are one thing, and we know that US Bank, who does a very good job of the same in this kind of a program, is less. But I'm of the opinion that when you have a nice working relationship with a trustee, an extra $1,000 one way or the
Yeah.
other is worth the lack of hassle and the lack of unfriendly feelings. It kind of develops if you have a problem with the trustee. And if you're happy working with Bank of New York and they're a great, you know, they're a great trustee, I would strongly recommend that you just expand that fee by you know, to allow for that to be included in that $25,000 cost factor.
So the $25,000 was over the 2 years, as I recall, right?
No,
It was
No,
the
that was the
one-time.
first
the
year.
one-time
That's the
fee
first
and
year.
then, yeah, first year
Yeah.
annual fee.
Okay, all
And,
right,
and
then,
included in that was the 15.7.
yeah,
That was the setup fee. That was anticipated
okay,
to be 2,500. If it needs to be higher, you know,
yeah,
to accommodate Bank of New York, that's certainly worth it because you have
yeah.
a nice relationship with them and you're happy.
And
I
it just makes
really
that
believe I've dealt with so
$25,000
many
number.
situations
Yeah,
where
they're too
cities and
easy to
districts
work
are not
with.
happy.
Yeah,
Yeah.
and we've had it established and it's a good
Yes.
working relationship. Just make
Absolutely.
that 25,000, 30,000. I mean,
Yeah,
and
just
yeah.
to
because the
have some room.
25,000 is
Yeah.
GM authority anyway, but yeah, make
Yeah,
it
that's
30
fine.
and then that way we have some room.
Perfect. And then you'll be happy. So
Yeah.
Is the board comfortable with that, changing the 25,000 to 30,000? Just, you know, we're only going to spend what we need to spend. We're not going to go out and spend more. Okay. So it sounds like Catherine and I have an idea of what this resolution is going to look like. Do we need to go over it one more time, or is the board comfortable in some sort of motion to put this in motion?
Could we go again, Rena, quickly, please?
Okay, so at the very top of the resolution, right, the authorization authorizing $5 million, not to exceed $5 million cash transfer from MPWD LAIF reserves to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for a laddered portfolio initial investment period not to exceed 2 years to secure a higher investment yield, and $4 million, not to exceed $4 million cash transfer from MPWD LAIF reserves to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for a laddered portfolio in initial period not to exceed 1 year to secure higher investment yield, and $30,000 for related investment purchase fees and professional fees, and the interim general manager to execute all necessary documents related to MPWD's investment in U.S. Treasuries. Then on the next page, page 30, we're going to have the whereas clause, the second one from the top. Whereas staff suggests the board consider approving a transfer of $5 million from LAIF to a laddered portfolio investment account for up to a 2-year short-term U.S. Treasury account in order to achieve higher yields. And whereas staff suggests the board consider approving a transfer of $4 million from LAIF to a laddered portfolio investment account for up to a 1-year short-term investment U.S. Treasuries account in order to achieve higher yields. And then the next whereas clause, Catherine and I are going to work on the language in there, but it sounded like we just kind of want to talk about what the laddered portfolio is. So I think what I heard, whereas a laddered portfolio investment account would entail establishing investments in U.S. Treasuries for 3-month, 6-month, 9-month, 12-month maturities with the MPWD discretion to continue the laddered portfolio investments. I think we talked about ending it there, but there might be some additional language possibly, but I think we're going to.
Rena,
Yes.
I can jump in. Yeah, so there we'd replace the language. It says for the terms not to exceed 2 years. We'd replace that with, so it's like continue the laddered portfolio investments for the terms specified above until such time the Mid-Pen decides to invest its cash reserves in another manner provided for in Mid-Pen investment policy.
And then down below, under the therefores, the board resolves, we would have, again, make a cash transfer of $5 million, not to exceed $5 million of MPWD cash reserves from LAIF to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for an initial period not to exceed 2 years to secure a higher yield. And to make a cash transfer of $4 million, not to exceed $4 million of MPWD cash reserves from LAIF to an established MPWD investment account to purchase an equal amount of U.S. Treasuries for an initial period not to exceed 1 year to secure a higher investment yield, and spend up to $30,000 for related investment purchase fees and professional fees, and then execute all documents related to the investment in U.S. Treasuries. So those are the suggestions that we would make, or those are the edits we would make to the board's resolution.
All right, thank you.
Anybody have any comments on that? Someone want to make a motion?
I'll make a motion only if Rana reads all that again. Joking, that was a motion.
Do we have a second?
A second.
Okay. Then we can take a vote.
Okay. Director Jordan,
Yes.
Vice President Bella,
Yes,
Director Schmidt,
Yes.
Director Zuka,
Yes.
and President Wheeler.
Yes.
Okay, motion passes unanimously.
Good.
Thank you, everybody.
Boy, I have to say, as an advisor, if I had to do a training film on how a board could work together to go through a particular subject and come to a really nice conclusion, you guys would be the model for doing that. It's really nice. We see so many contentious councils and boards that we have to deal with. You guys are terrific.
Thanks, Bud. Thanks, Rob. Thanks,
Yeah.
Stephen.
Thank
Yeah,
you for
thank
having
you,
us
gentlemen.
tonight.
So,
Thank you, gentlemen.
Have a
Thank
good
you.
evening.
We'll be in touch, bud.
okay, sounds good, Rena. Thank you so much.
Thank you. Good night.
All right.
So let's see. That was 8A. We're now to 8B. Memorandum of agreement among Bosco.
Yeah, so this is going to be your first opportunity to see our latest employee, Assistant General Manager, Kat Wolfing, make a presentation to the board. So Kat, how do you feel? She's been ill, so we're going to see how far she can go.
Yeah, we can't hear you.
Is she muted? Is Kat muted?
Kat, we can't
Yeah,
hear
we
you.
can see you talking, but can't hear you.
Can you hear us?
She's at home doing this.
Yeah.
Well, let me start. So this is the topic that we brought to the board. I want to say back in April. It's an alternative water supply idea that San Francisco, the SFPUC, has been working with a couple of wastewater treatment plants in the area, and also the cities in the region. The city of San Mateo's wastewater treatment plant, and then the Silicon Valley Clean Water Plant, which takes wastewater, I believe, from Belmont, San Carlos, and Redwood City. And the idea is to eventually get to a point where a 16 million gallon stream of the wastewater from these two plants would be treated at an ultra pure water purification facility nearby. And some of the water would go into the Crystal Springs Reservoir, and then potentially the other portion would go into the distribution systems to us potentially to Cal Water serving San Carlos, and then the city of Redwood City. So the discussion's been going on, and we're at a point now where there is a basis of design report that needs to be funded so that the next level or next stage of the work can take place. And that's what this is all about. We've been going back and forth over the last few months to develop this memorandum of agreement amongst the agencies. And if you recall, when we brought this to you, we mentioned that the basis design report is a little over $1 million. And we all kind of agreed that San Francisco or SFPUC was going to pick up about $500,000 of it. And then the other agencies, City of Redwood City, San Mateo, Cal Water, us, would pick up a 9% or about $93,000. And then Bosco was even going to kick in about $50,000 in order that they hit that budget of a little over $1 million. So that's what we're bringing to the board. You've seen this. We talked about it. I remember having a conversation about at what point in time is the rubber going to hit the road, and are we going to have an opportunity to say, hey, we're a small fish in a big pool. We just want to make sure we don't get left out from the discussion. We're not at that point yet. We're at the point now where we just need to do the next level of work. And the idea is to seek funding, federal funding, state funding to help, defray the cost of this major capital improvement program. And again, we're talking projects that are probably 15, 20 years down the road. There's nothing that's going to take place in the time frame that we're used to with the capital projects of the district, but it is a long-term project. So that's the idea. What CAD is attached here is the memorandum of agreement and a resolution, and also the basis design report from Kennedy Jenks, who's the consulting engineer that's been hired actually through the Silicon Valley Clean Water Agency to do the work. Kat, do you have anything that you want to add to this?
Can you hear me now? Did I fix it?
Yes.
Okay. Sorry. Well, just a little bit on the time frame. The most recent estimate is that this would actually be built and completed by 2037. So we are talking a long-term time frame here. And that was about it.
Any thoughts or questions of the board and the action that we've got before you?
See, Louis, you had a question?
Yeah, just a comment that this topic was discussed at length during the BUSCA, and there were a lot of questions that came up, but in general, the board and most of the directors agree that this is the direction that we need to be heading, and these are the areas that we need to explore, going into the future. There was a lot of talk about comparing it with other sources of water, including diesel and all that, but clearly this would be the area that we need to spend our energy on. So I was very pleased to hear that from the majority of the directors at Bosco. Just wanted to share that. That's all. Thank you.
Brian?
I am very supportive of this. I do have a question on page 48. Towards the bottom, it says the project has an estimated cost of $700 million. Is that a typo? That I tried to remember what a similar project in Silicon Valley or Valley Water District costs. So I think I looked it up briefly. It looked like it was around 70 million.
You are correct, and I don't have the specific number in front of me right now, but
Okay, maybe we can get some clarification at some point.
yeah, I will find that.
But in general, I'm very supportive of it. I saw that process happen at Valley Water, which was, and they're not the pioneers. It's Orange County that was the pioneers on this. So I think it's a great idea. Glad it's moving forward.
Anyone else? Yeah, I think it is the way we're going to have to go. I think we need to keep our minds open to other alternatives that may pop up, but it's always going to be an expensive water source, but it is fairly reliable. just because it's recycled. But it's going to be expensive compared to buying water from Hetch Hetchy at the current time. Yeah.
I think most every source is going to be a little bit more expensive than buying it from HHE.
Yes. Even the other alternatives that they've been talking about in terms of other reservoirs or buying water and wheeling it into the system or whatever, we're also coming out with fairly high per acre foot numbers.
Right. If there are no other questions, Kirk, I'm prepared to make a motion.
Okay.
Okay. All right. I'll move to consider resolution 2022-24 approving a memorandum of agreement among Bosca, California Water Service Company, and the cities mentioned with the Mid-Peninsula Water District and Silicon Valley Clean Water regarding SF Peninsula Regional Pure Water Project basis of design report.
Do we have a second?
I'll second.
Then we can call a roll.
Oh, there's Monique. I thought maybe
Monique?
she was on break. I was going to take over for her. Sorry, Monique.
Oh, that's okay. I didn't realize I was on mute. Okay, Vice President Bella,
Yes.
Director Zuga,
Yes.
Director Jordan,
Yes.
Director Schmidt,
Yes.
President Wheeler.
Yes.
Okay, motion passes 5-0.
Okay, thank you. So that brings us to 8C.
Page 135, money.
8C, authorizing purchase of a car.
Yes, correct. That's me. So during my discussions with the board with regard to this position, I mentioned to them that the district currently provides a vehicle for me to operate to conduct the district business and to commute. The current vehicle is, as you saw in the report, a 2018 Kia Niro plug-in hybrid vehicle. Runs great. The issue is that the clean air vehicle sticker that allows me to drive the vehicle in the HOV lanes, the high occupancy lanes, expired at the end of the calendar year, and the state does not allow you to renew those stickers. Once the time period's up for those stickers, you're done. And so for me, being able to drive in the high occupancy lanes saves me, at least an hour of driving in the morning and especially in the evening. And so I think we agreed that we would go ahead and purchase a new vehicle. So I sought some proposals from different dealerships after settling in on a car, finding out that the new vehicle market, as we all know, is very tough right now. And I was also trying to keep the cost of around $40,000. And so the vehicle that I could find in that price range turned out to be a Chevy Bolt EV, which means it's a battery electric vehicle. And the dealership in Boardwalk here in Redwood City had a couple of brand new ones, and I was able to put a deposit on it with a credit card, and then I actually used the interim general manager's authority to put down another $20,000 to hold the car, because these cars are just they're going out as fast as they're coming in. So what I'm requesting here is just to kind of follow up on that. Now the remainder of the cost of that vehicle is $20,600, and I'm requesting the board approve this resolution that gives me the authority then to finish the purchase of that vehicle from Boardwalk Chevrolet, so that the interim general manager can use in his business. So that's the action item. Are there any questions or comments to the staff report or what the request is?
Lewis?
Yeah, Kirk, I think we discussed this in the past, and I think we came to a consensus that it is needed, is approved, so I have no problems with this proposal.
Anyone else have a question or concern?
I'll just say that this is consistent with all the discussions that we had with Rena during our conversations about him taking over as interim GM, that understood the importance of the vehicle and how that played in. So
And I appreciated all that too from the board.
An EV
Brian?
vehicle, by the way.
I just want to say I'm glad to see the district is buying an EV. Hope we can get some more over time.
Yep.
And I think it's clear, but I'm not able to say it anyway. This is the district's EV, district's vehicle. The interim general manager is just using it during
That's
his
correct.
time here. You know, it stays with us.
That's correct.
I'm happy to move resolution 2022-25 as stated.
I second.
Okay, we can call the roll.
Director Schmidt,
Yes.
Vice President Bella,
Yes.
Director Jordan,
Yes.
Zuka,
yes.
President Wheeler.
Yes.
Thank you.
Motion passes 5-0.
Okay, going on to 8D, discuss return in-person board meetings.
Yeah, so there has been some changes that are brewing in Sacramento. I didn't have enough time to put it fully on the agenda because we just heard this from Hanson Bridget the other day, but evidently the governor signed an Assembly Bill 2449 that's talking about the Brown Act and public meetings in the future. There's a change in the law, and I think it takes place on the 1st of January of 2023. So I wanted to make the board aware of that. And so what I want to do is next month in October, bring that information with the board to talk about it and see how the board may want to pursue, because there is still going to be an option for a hybrid meeting, but it's going to be very particular in how that hybrid meeting takes place. You know, but what they're saying is that now it's just time to get back into open sessions. So I just wanted to make the board aware of that. So when we come back to the board in October, we'll have some more information to talk about AB 2449, what it means to the Mid-Peninsula District Board and the public meetings that you've been conducting.
Brenna, if it would be helpful, I could
Yes.
provide a bit of an update right now as well.
Thank you.
So the law does go into effect January 1st, 2023, but it doesn't make any changes until the January 1st, 2024.
Okay.
And it also does not make any changes to the existing legislation that you are currently relying on to have remote meetings. That's AB 361. So you can continue as long as there is still a declared state of emergency. You could continue having remote meetings like this until January 1st, 2024. In terms of, you know, when will the potential state of emergency be lifted? That's a bit of a crystal ball. They can only be lifted by a vote of the legislature or the governor. The legislature, the Republicans in the legislature have tried a few times to lift it and have not been successful. So it seems like that would be an unlikely avenue. The governor, it's hard to predict. In general, the states of emergency will frequently stay on the books for many, many years. But this is a little bit of an unusual state of emergency. So all that is to say that you can continue meeting as you have been, and you have continued flexibility at least through 2023.
Thank you, Catherine. So there's no action for the board. It's just kind of an update of what's going on. But if the board wants to talk about it, we can.
So I guess the question would be whether it's actually feasible with the current equipment and service to have a hybrid board meeting with people present and with people dialing in type or calling in on Zoom or something similar, and how effective that would be.
So as you can see tonight, Monique is actually in the boardroom, and she is operating the board agenda from that boardroom, and we've got the hardware equipment that we purchased several months ago and using it. And right now, we had some issues here recently, and Kat's going to kind of go over those issues in her assistant general manager report that had to do with a firewall to protecting the district's server systems. But right now, we've got that cleared up. And so if at some point in time the board wanted to have some sort of hybrid meeting where, some of the board members stayed at home and got into the regular board meeting that way, or some of you wanted to come into the district office here and conduct, your business here, we could probably do that. It's that when I was reading the summary from Hanson Bridget, I mean, they were saying that you're going to be able to have, these hybrid meetings in the future, but I think they're going to require maybe some more thought processes and potentially some equipment expenditures in order for us to do it the way, they're talking about in the future. But again, I'm glad Catherine knows a lot better than I do. It sounds like we still have some more time to think about it. We don't have to rush into it, that we've got some more time to discuss it and the board to discuss, potential hybrid meetings if that's what the board wants to do. So I think that this is just basically some information for the board at this point in time.
Right. Louis, you had a comment?
Yeah, for what it's worth, the same question was raised at the BOSCA meeting, because at the BOSCA we were also discussing whether we should go in person meetings, and there was quite a bit of discussion whether we could do a hybrid, because there are certain members who are still not comfortable meeting in person. And the decision was just to continue with the virtual method for the time being, even though we do have a location and we have a memorandum of agreement on the use of this new location in Burlingame. But it looks like the meeting are going to continue virtually.
I'll just add that the legislation is not well drafted and not as helpful as we were hoping. So,
so what's new?
Yeah, exactly. So I anticipate there will be many questions. We already, internally on our own end have been vetting it and putting together a list of FAQs just from all of us reading it and having questions. So that will be an ongoing discussion, and we're happy to support you all as we move into this brave new world.
Nothing else from staff here.
It sounds like we should continue at least in October with the virtual meeting, and we may want to think about it for some of the other meetings, like the finance committee or something like that. But it's more a question of how well our setup works with a larger group than some of the smaller meetings. Yeah. Okay. So let's see. 8E, received BOSCA update.
Yes, that would be me. Thank you. Yes, the meeting was on Thursday, September 15th, and it was just a regular meeting. And one of the discussions that we had during the meeting was obviously whether we should continue with the virtual, and I talked about that already, and it looks like we're going to continue that way. And we're not even considering a hybrid approach yet. We're just gonna continue on as on a virtual mode. Then we had a like a presentation or an introduction, basically, with the new Deputy General Manager and Chief Operating Officer of SFPUC, who is Mr. Ronald Flynn. He had addressed the board before, but apparently now under Herrera, he has been appointed as the Deputy General Manager and Chief Operating Officer. And he said that he's going to continue to meet the obligation of the 184 MGD to the wholesale customer and being a good steward for the environment. He reiterated the SFPUC's commitment and engagement in the discussion with the state for consideration of a voluntary agreement for the Tuolumne River. So that was a presentation by him, was a short, like an introduction to the directors. And then we had the usual presentation by Steve Ritchie, which Rena usually gives. So I will not go through that because he has a the slide presentation on that as well. And then we had a very nice presentation from Julia Nussbaum from Stanford University. She is one of the members of the water managers, the WMR, and she did a very good job. And this was as a continuation, basically, of what our own former general manager started a few months ago, Tammy, when she made a presentation to BASCA, and this was under one of my proposals to BASCA that we should also receive a presentation by one of the water managers at one of our meetings as often as possible, because we feel that that is actually where actions and decision that will affect the trenches and the digging of the dirt take place. And we wanted to hear from those people that are boots on the ground, so to speak. And we shouldn't be hearing just presentations from SFPUC and the high level political decisions. We should also be hearing from GMs and the representative of each agencies. And it looks like it's moving along pretty good. The proposal is taking some traction, and this would have been the third presentation that we had from a water manager, starting with our Tammy, and then we had another one from the East Bay, and now we had Julia Nussbaum from Stanford University. We had two very long closed sessions that we had to discuss because one of them dealt with the CEO performance evaluation, and the other was on the usual litigation. Anyway, so most of the meeting took place in closed session. And those were the highlights of those meetings. We meet again on November 17th. And that's all I had. That's
Okay,
it.
thank you.
Yeah, Rena, I don't know if you
Any
wanna
questions?
give the report on on anything else that you had at the WMR.
I think you covered all the high points, Louis. Yeah.
Okay.
The only difference is we didn't have Steve Ritchie at our WMR meeting. It was Allison Kastama, I mispronounced her name.
Kastama, yeah.
Yeah, she's the liaison. She did Steve Ritchie's presentation, but we had Manisha there. We didn't have Mr. Flynn there, but we talked very similar things.
Mhm.
We saw Julia there. She's one of the WMRs.
That's it. Thank you.
Okay. Then Rena's report on the regional water system drought conditions.
Yeah. So let's get into this. Monique, page 143, the next page down, just showing the California drought map. This is the drought map from a year ago, August 3rd, 2021. And just what caught our attention again last year was just the exceptional drought, that blood red, dark red that covered, 46, almost 50% of the state. And then go to the next slide. A year later, in August 2022, that same area is much smaller, but concentrated in pretty much the same part of California, the Central Valley of California. And so, even though we keep talking about the drought, it almost feels like, and just looking at this map, and this map is derived from a bunch of information. The drought is not as severe, one could argue that, as it was last year. And so the next slide, Monique, is September 2021. And again, it looked very similar to August 2021, where 45, 46% of the state was in that exceptional drought category. And if you remember too, I also showed part of the United States, and so that dark red exceptional area extended into Oregon and up into the state of Washington as well. So this September, the next slide, again, looks very similar to August 22. The exceptional area is still concentrated in the Central Valley of California, the lower portion of it, not the entirety of it, like it was last year. So even though we're in a drought stage, the extent of the drought, again, based on the parameters that this map is put together by the University of Nebraska and USDA and NOAA and a bunch of other folks, it's not quite as bad. So then now let's go to the reservoir levels. And so again, these are the major reservoirs back in August of 2021. And again, I always like to point out Shasta, Oroville, Don Pedro, and San Luis Reservoir last year, they were at, 44%. Shasta was at 44% of historical levels for this period of time for August of last year. And San Luis Reservoir is at 40%. It's really low. And then just go down to the next page, which is now a year later in August 2022. You can see that Shasta is a lot better. Is at 56% compared to 44% last year. So better, still not good at all, but better. There's more water in Shasta this year than there was last year. And the same thing with the San Luis Reservoir. There's more water in San Luis Reservoir in August this year than there was last year. And it's interesting, the Don Pedro, it didn't change much at all. Again, I think a lot of it just has to do with, again, SFPUC or the water bank is in Don Pedro. And so there's water there that is stored for us to use over here. And I think that's a good chunk of that's at least 500,000 acre feet. So let's go down to the next one, Monique. And so again, it's looking at September's water levels. This is September last year, and it just got uglier last year. And then scroll down and you can see September this year, not quite as bad. Not pretty, but not as bad as last year. And it just kind of makes you think about those super rain events, those what I call those atmospheric rivers that we had in October last year, December last year, just dropped a lot of water and then a lot of snow in the Sierra Nevadas, and it helped out. It didn't get us out of the drought, but at least we didn't get as bad as we were last year. And then this next slide, I was noticing that I didn't put this in the July reports. I go, geez, I forgot about this, but again, we were tracking the rainfall in certain areas up and down the state of California and showing that, at the beginning of calendar year 2022, we were just way above normal, way above what normally the rainfall totals are for all parts of the state in January, and just slowly how that lack of rain that we had throughout the spring and of course throughout the summer in California, those, percent normals just started getting back down to normal to the point where now it was below normal. So that's kind of why I colored some of these columns in green and yellow, just saying, hey, look, we're below normal. And actually, I should have colored the Palm Springs one in that June column and the July column at 46% of what their normal is. So, I mean, that should have been red. It just there was no rain in 2022 really to speak of. And it was nice to see early this week and last week a little bit of rain, but I'll probably see what kind of information is up and pull this back up again just to kind of see how rain tracks through these same areas in 2022 and 2023. Just put it that way. And then here's the forecast. Even though we got a little bit of rain, you know, the forecast was not getting much of any kind of rain events in our part of the United States. Precipitation, you've seen this, it's just reflecting that in August and September, there were just small traces of rain, but not much at all to report. Next slide, and Hetch Hetchy, same thing. You know, if it wasn't for those atmospheric rivers, the red line is showing the 2022 water year. If we didn't have those atmospheric rivers in October and January and even a little bit in May or April, I'm sorry, we probably would have been back where we were in 2021. Not good, but it really helped. It didn't get us out of the drought, but it was better than not, but still below, you know, the median, the 30-year median for precipitation in Hetch Hetchy. And this is just a look at the Bay Area, the rain, so we can go past that. Nothing to report there. Now we can take a look at storage. So kind of what Louis was talking about, Steve Ritchie was talking about this. And what I did is I put up last year for the same kind of period of time and this year. And on the far right, just trying to compare, you know, this year to last year. And so if you take a look at the far right, you can see like at Hetch Hetchy, there's actually not as much water stored there, you know, is actually further down than what it was last year, but not bad. And a lot of that was they had held a lot of water. You remember at Hetch Hetchy while they were doing some work in the tunnels that lead to Dom Pedro. And that's why Dom Pedro is actually down this year, is because again, that water is being held in Hetch Hetchy back until they got their work done. But just overall in general, when you compare the Tuolumne storage, it's at 67% of capacity this year compared to last year, it's 68% of capacity. And the big change there is the water bank. There's just less water in the water bank this year. It's just being used up because again, we weren't able to get all the water out of Hetch Hetchy, but even so, there's just not as much water, and I guess in the watershed that was tracking through. And then in the local areas, not much change. The local storage had 76% at the end of August. Last year at the same period of time, they were 72%, so not much change, not much difference. We had close to 1 million acre feet stored at the end of August this year. Last year is a little over 1 million acre feet. I mean, so we're not sitting too bad. It's just, you know, we've got to think about water conservation to make sure that we've got water put away for that time where we're just not going to have any water. And then the next slide, Monique, the total deliveries. This is what Mr. Ritchie shares with us as well. Typically with Allison, but shown in that green line there, that's the 2022 calendar year. So for that period of time, which is the last week in August, the average delivery is about 210 million gallons of water a day. And again, just so you've heard me remark that Mr. Ritchie was saying, if we can stay right around that 200 million gallon a day, 210, we're doing pretty good. You can see the 2015 mark, that orange line. That's where they, of course, would like us to be. We're all trying real hard, and it didn't help when we had that really hot weather that hit us at the end of August and first part of September. And actually, we just got our water bill from SFPUC, which covered the period of mid-August to mid-September, and it was like $650,000. I think it's a lot of it because, again, we were using water as much as we were trying to conserve. It was just really hot that last week in August and first part of September. The next slide, Monique. Let's take a look at our water use just on a monthly basis. The August per capita use was 78 gallons per day per person residential. And I've plotted this for July and August. And what you'll see is the August water purchases or takes from San Francisco almost mirrored each other comparing 2021 to 2022. There's just a difference of a couple hundred units of water. But in June, you can see that, folks are really making efforts to conserve water. And there was quite a difference, almost 20,000 units, or actually over 20,000 units of water difference comparing 2022 with 2021. But made up with it again, I think a lot of it just had to do with the heat that we had at the end of the month. Next slide, Monique. And this is just the cumulative water use. I keep evolving this graph. So what I've got here, you've seen the lines. So the blue line is the 5-year average. The green line is our cumulative water use from January. And then the orange line is where the SFPUC would like us to be cumulatively speaking. The bar charts down below show what our use was in July and August. And then the orange bar is where SFPUC would like us to have been in those particular months. So that's what I'm showing there. And if you recall, we first started beginning of the year, we had been exceeding what the SFPUC wanted us, or where they want us to be by, I want to say, as much as like 10 or 11%. And now we've gotten it down to, we're about 1.5% more water use, so 11,000 CCF than what the SFPUC, would like us to be, which isn't bad. Our customers are doing a really good job trying to make the best use of our water supply. Next slide, Monique. And then again, just the Tuolumne River water that's available to the regional water system hasn't changed. It's at 201,000 acre feet, which is far below the amount of water that would be needed, that 598,000, if we were to fill every bit of the entire regional water system's water storage facilities. But it's much better than the 57,000 acre feet, which is what we were able to take from Tuolumne River last year in 2021. And then the next slide is just a snowpack, and again, there's no snow. The snow melt's gone. It's all gone. And I think that's it. Are there any questions or comments or suggestions on information that would be the board would be interested in seeing in terms of that drought information? It's a lot. It's interesting, but it's a lot.
Louis, you had a question, comment?
Yeah, right. A quick question, quick comment rather. Have you, in talking to the GMs and maybe anybody in San Francisco, has anybody talked about the recent precipitation? Did we actually have snow up in the Sierras?
I haven't heard that from anybody, the SFPUC or the water managers, but just the local news was talking about there was some snow over the weekend, but I'm not sure how much. I can't imagine it's staying on the ground either. And then the temperatures are going to warm up again even this weekend. So if there was any snow, I imagine it's going to be melting. And the ground's so dry, the ground's probably going to absorb it.
Mm. All right, thank you.
Okay, if we don't have any other questions, then we can go on to management reports, the interim general manager / operations.
Yeah, so this is my first crack at this, and I basically took Tammy's template that she had in July and just kind of updated it with information pertinent to. So you see a follow-up to the July board meeting, what we did, and then just doing a 3-month look ahead. So you see kind of the things that we're planning on bringing to the board over the next 3 months. The biggest one I'm going to say is in October is just a response to the grand jury and the report about the water worry. And so we'll have a response that we'll bring to the board for them to approve before we send off to the grand jury. And then after that is just on page 164, Monique, is the start of just the monthly operations report that you've seen from me in the past. And the things that I wanted to point out here is actually this first bullet under projects. The El Camino Real project is complete, but it's also on this evening's closed session. We're going to talk to the board about that, and Jubin's here for that. He's going to be a part of the closed session. And then on page 165, I always just kind of like to share how busy development is in Belmont by sharing the number of location requests we get. So in July, we had 268, and in August, 335. So, I mean, we spend a lot of time going out there and marking our facility just because of activity taking place in our community. The next page on 166, we over the past couple of months, we had 2 water main breaks that we dealt with in July, and then in August, we had several service repairs, and I want to point out the repairs. You'll notice the locations. There were 3 on Hastings Drive. Hastings Drive has got the services there. They're a type of plastic, and we're in the process of putting together a capital project, hoping to get that out to bid here quickly to replace these service lines because the plastic is just rupturing. The over time, the plastic has gotten brittle and it's just causing us problems. So you can see here, we had 3 that we had to respond to. So we're hoping to go in there and correct that and replace these plastic service lines with our copper standard that we have now. So we don't have to worry about service leaks out there, but I thought I'd point that out there. And that's all I wanted to point out in the operations and the interim general manager report, unless the board has any questions or comments about what's stated in there. Yep.
I'm not seeing any questions. Okay, so Assistant General Manager.
All right, so apologies about my technical difficulties with my microphone earlier. So I've been busy, very busy in my first 2 months on the job, as you can tell from the report, covering a whole lot of ground, a whole lot of breadth. I wanted to first follow up on your question, Director Schmidt, about the total cost of the prep project. When you suggested it was a typo, I thought for sure 700 million seems way too low for that much infrastructure. I mean, that much pipeline that goes into it and the plant upgrades and all of that. But I went back and confirmed that is based on the July 2022 Title 16 report. That's what they're coming up with, the high end cost estimate. I know earlier estimates were on the order of 1 billion. I wouldn't hold my breath. That 700 million would be necessarily real, but that is what the estimates are. So one thing I've been, and I don't think anyone anticipated this at all, spending a lot of my time on, was our technical issues with virtual meetings. So about end of August, we suddenly started having problems with all virtual meetings, Zoom, Teams, GoToMeeting. It didn't matter what the platform was. The audio quality was terrible. The video quality was terrible. We couldn't see screen share. And it was only affecting us sitting in the district. Any consultants on the other end on the call didn't have these issues. So it was, a huge effort. I certainly wasn't the only one involved working with Stepford. I think all of us spent time on the phone with them, trying to troubleshoot, trying to give them information, trying to give them examples of what was going on. And certainly it took all of their team to figure it out. But eventually we did, and the resolution was actually just adjusting a firewall setting. So we actually debriefed with Stepford. Rena and I went and met with them earlier this week and found out more information. So what happened is Homeland Security came out with new recommendations for high-risk operations organizations like ours. So they made updates to all of our security systems regarding that. And there was one unintended consequence where it was falsely flagging one aspect as basically denial of service attack. So part of our system thought anytime there was a Zoom meeting that we were under attack. So that was resolved, that setting was changed. Our security is not compromised in any way by adjusting that setting. But that is fortunately the resolution. Another thing I've been working on is developing a consumption history database. So this is a tool that I, in my consulting life, I would often develop for other clients to really kind of analyze and break down data and kind of test, hypotheses. And when we started working with when I got involved with the rate study consultants, it kind of became evident that it would come in very handy in this case. So I started developing that, and I can, been talking with Rena about ways we can use it for analysis going forward to support decisions. We also started recruiting for the water resources coordinator position. We've had a couple bites, but have kind of decided to kind of cast the net a little bit further and, advertise it a bit more. And then the next couple items here you can see are just, all of the things, or I'm certainly not even inclusive, but a lot of the things I've been trying to get up to speed on, learn, meeting with Tammy every week with a, huge list of information, as well as all of these, introductory meetings with all of our consultants. And you can see, list of the meetings and conferences attended. Went to CSDA annual conference, as well as a slew of other, smaller meetings. So I don't know if the board has any questions about what I've been working on.
I was going to ask whether or not you found the so you want to be a general manager workshop enlightening.
I did, and I have to say that a lot of the aspects that they pointed out as being particularly, kind of important, personality wise and preference wise, was like the polar opposite of my previous job, and well, is very reaffirming to me. So I did very much enjoy that session.
Any questions? See none, we can go on to administrative services.
Okay, thank you. I don't have a lot to add, but we have completely transitioned over to biweekly payroll, which has been, we've had a few hiccups, but it's gone really good. And I can say that Missy has done a really good job and just persevered through many, many challenges. We've made some really good changes to our payroll platform, so that's also been really good. I have included the utility stats here for you. We do have 22 payment plans in place. The SFPUC water rates have been applied. We have had one customer take advantage of the LEWAP grants. I've included the PARS account activity for both July and August. The historical water use is here as well. And then I did want to just remind some of us that we do have, oh, the owl was moving, that was weird. I thought somebody was coming. Sorry, I'm in here by myself, so. Anyway, there's a few of us that have to get our ethics and our harassment certificates renewed. So I have you marked here. Let me see if I can find the page. Here it is. So Kathy Jordan, Jubin, Rena, Lewis for ethics, and then I think I had the wrong date down for Kathy Jordan for harassment. So I'll update that. And then it looks like Kat and I are the ones who need to do it for sexual harassment prevention. So if I do have your date wrong, you can just let me know and I'll update it. And that's really all I have. Unless somebody has questions.
Okay. Then Jubin, district engineer.
Good evening. The report is in the packet. We were anticipating coming to the board to accept this project, the Hastings Vine Belmont Canyon Water Main Project. All work is done. The last piece of work that was remaining to be done, and it has been done, but the last piece of work was to slurry seal the roadway, which is normal, and it's something that we have on all of our projects. We had a slight hiccup in that we were going to slurry seal the entire length of the project where we touched the road. And we heard from from the City of Belmont inspector to stop short in a certain area because the pavement was in poor shape the rest of the way. Made a lot of sense, so we stopped and we moved on with closing out the project. Then we got communication from the city, another part of the city saying, why did you stop short? We're getting complaints from the residents. And so it took a while to kind of resolve the fact that they told us to stop short. And therefore, we're going to come to the board next month to accept the project. So if Monique, if you can scroll down to page 2, the numbers are not going to change. These are the final numbers. Typically, at the very end of the project, the last progress payment, which will be next month, we'll have a breakdown of all the change orders and what they were for and so forth. So 4.3% change order for this project. It's a little bit above our average, which is I think 4%, but still below our target of 5%. And underground construction is about, in California, average is about 10% change order. So we're well below that. Any questions I can answer? I'm trying to keep it short. I know we're pretty late into the evening, so, but the project was, in our eyes, a success. Everything's in operation, and no safety issues. And we got that one complaint about the slurry seal, but I don't really chalk it up to anything we did other than follow what the city wanted us to do. So.
And Jim, just to be clear, we didn't pay anything to the contractor based on city direction, did we?
No, well, the city asked us to, the city asked us to stop short of what we were going to do anyway. So
right.
we ended up paying less to the contractor.
Okay.
Because
I was just making sure we didn't end up remobbing out there and doing work or anything like that. And that the city isn't costing us money based upon their inability to provide us consistent direction is all.
Yeah, we're going to have a meeting with the city next month. It's scheduled for like mid-October, actually October 14th, or it's our quarterly meeting. So we're going to discuss this. There were some issues out on this project as far as getting conflicting direction from the inspector. They've had some turnover, a lot of turnover at the city. And so they're actually looking for a new city engineer as of last week. So because of that turnover, that has caused some inconsistency as far as communication with our inspection team and stuff that they approved during the encroachment permit. Now that we're asking for more stuff in the field. So there's some stuff to work out, Matt, but we're going to make sure that's resolved with the new personnel there.
Great.
Any other questions?
Any other questions?
Thank you.
Okay. Then financial reports.
Is Sheldon still on?
Oh, I'm here.
Okay, there you go.
Okay.
I'm waiting for the slide to get to the first page. I might have fallen asleep though. It's happened to me before. I actually missed my presentation one time in a Zoom meeting. It was a 4-hour-long meeting and I was at the very end and I fell asleep. And they tried to wake me up, but they were unfortunately unable to. I'm an early starter. I get up at 5 in the morning every day. All right, so here we are looking at the July 31 and August 31st, 2022 budget performance reports. We're kind of wrapping 2 in 1 to make up for the July meeting, August meeting. And the focus is going to be on the August financial information because that's the most relative at this point in time. But if there are any questions going back to July, we do have those reports as well, so we can take a look if needed. The summary in front of you, we'll start with talking about some of the changes I made to the presentation. What I did was I wanted to align the reports presented to the board with the audit presentation and with generally accepted accounting principles. And so I moved some of the operating items down into the non-operating category. So we recategorized property tax revenue, lease revenue, and the LAIF interest income to be a non-operating revenue. So you can see that in the reports. So you'll see like 1, 2, 3 lines down, it's kind of detailed, but property tax revenue with a budget of $420,000 is now in the non-operating section, as well as the lease of physical property, and then the interest revenue. Go ahead and go back up to the summary, please. One other thing that I did realign and recategorize was that the COP premium for some reason, I'm not sure why, the COP premium was reported as a deferred inflow of resources. It's technical accounting, GASB, governmental accounting standards, and it really should not be reported as a deferred inflow of resources. Doesn't have any difference, doesn't make any difference to the financial statements in terms of net position. So I reclassified that in the reports for the board to be reported with the COP. So instead of the premiums reported separately from the COP, they are now included with the COP. So the certificates of participation are reported gross, including the premiums. Some financial highlights for August 31st, 2022. So through August 31st, the district had a net surplus of $648,000. The water commodity charges totaled $2.012 million, and that is 18.3% of budget. Fixed system charges totaled $529,000. And in the reports, I actually put a target number, but that target number is something I'm going to look at as we go forward, because it's simply just 12 months divided by, the total year divided by 12. So 16.6% is about target. And the service line and installation charges were $45,000, which is 75.5% of budget. So with these though, you know, $45,000 is a very low number in terms of your total budget. However, when you think of it in terms of percentages, 75, 76% is quite a bit. But then we also know that the service line installation charges can move and fluctuate like that. Salaries and wages totaled $238,000, which is only 8.7% of budget. So I'm thinking down the line here, we're going to see some increases as we get into some of the PERS payments and contributions and whatnot. Service line and installation charges, sorry, wrong line. Payroll taxes and benefits totaled $118,000, which was 11.1% of budget. Purchased water totaled $1.067 million, which is 16.2% of budget. Typically with purchased water, when I'm analyzing that, I'm thinking different months. And so again, I'm going to take a look at that long term and see if what we would expect to be a target would make more sense if we have some history behind it. But right now, that's actually right on target in terms of the operating budget. Total expenses are well within the year-to-date targets at 13.4%. However, membership and government fees were actually 26.3% of budget. And that was mostly because of BOSCA membership assessments and environmental health cross-connection inspections. These were more than expected at this time of year. And also the utility costs were up. They were 21.7% of budget. So increased electricity costs for pumping caused that to happen. Unrestricted cash and cash equivalents total $14.189 million. We got an investment summary report. And then the capital assets totaled $30.367 million, with the related COP, including the premium, at $17.149 million. Deposit liabilities, I'm mentioning this because a year or so ago, there was a huge drop in that because that deposit liabilities were cleaned up. And so that, as of August 31st, 2022, the total deposit liabilities were $507,508, sorry, rounding up. And the unrestricted net position, if you don't know what that is, ask me, I can tell you, was $15.379 million, with a total net position of $35.252 million. Now, the difference between the unrestricted and the total is your net invested in capital assets. One note to make is that there is a new accounting standard coming for June 30, 2022. We haven't quite closed yet for 2022, and we're getting ready for the audit as we speak. But GASB 87, Governmental Accounting Standards Board number 87, that will be implemented as of June 30, 2022, and that has to do with lease accounting. And you're going to see some new terminology in there. You're going to see things such as right of use assets, and you're going to have lease liabilities that you didn't see before. And then an analysis has to be done on the district's leases, lease income and lease expenses to determine what those may or may not be. So that's still in the works. And as we move forward for 2022, and we implement that, we'll start picking that up on a monthly basis in the financial statements as well. And so that's my quick summary for August 31st, 2022. If you'd like to get into any of the reports, feel free to ask any questions. I'd be more than happy to answer them.
I'm not seeing anybody raising their hand, but it is getting late, so I guess we can move on. Okay. So, director's reports. Let's see. Louis, you have a director's report?
No, I'm good this month, so I don't think I can't remember if I attended the HIA meeting. Maybe I did. Forgot.
Yes, you did.
Okay. Yes, I did. Yes, I did. It was so long ago, but I did. Yes, yes.
Okay.
And that was basically it. You know, we didn't have a meeting.
Matt?
Nope, nothing to report.
Brian?
I'll report that my wife and I spent our 15-year anniversary last month in Hawaii on the Big Island. And this is water related. We stayed on the rain-filled side of Hawaii.
Hilo,
And
on the Hilo side.
the Hilo side, exactly. In some remote places. And they didn't use municipal water, they used rainwater. And then they described their rainwater as going through two levels of reverse osmosis in ultraviolet. And I said, why do you do so much treatment? And they said the rainwater comes from the roof, and the roofs have all kinds of animals pooping on their roofs. So the level of treatment they do on these individual homes are comparable to what we're looking at for SPREP, which I thought was kind of interesting. So I don't know. Anyway, nothing more to report.
Okay. Kathy?
Just real quick, I met with Rena yesterday in our prep for the board meeting, and we talked about potentially revisiting a 2x2 with the city of Belmont. And after listening to Jubin's report, I wanted to make sure I brought it up that if it's something as a board, we want to try to revisit quarterly meetings with 2x2 with the city manager, general manager, and board president, vice president, and mayor. I'd be happy to help lead the charge with the city to start those quarterly meetings. That's it.
Key word would be to start, because they never actually happened after much trying. In fact, I think one of the current two people that's running for mayor was notoriously hard to get a hold of and pin down on the schedule.
I can text him at any time if we need to. I do think it's a worthwhile endeavor if we can make it work. And I told Ren I'm happy to, help him with getting in touch with the city and getting something on the calendar. Because I have actually spoken to the different council members and expressed my desire for them to refer to us as a district and not whatever they call us, the department, the water department. So yes.
Yeah, that would be nice.
The water board, they call us the water board. That's
The
what.
water board.
Yeah,
Oh,
the
God.
water board. Yeah. Thank you for doing that. I do it too.
Prior to the elections, it's you got a lot of positive feedback. After the election, Matt is correct. We didn't get any response at all. As a matter of fact, I think the only meeting we ever had between the water district and this, and it was the president, vice president of the district, and the mayor and vice mayor. Nobody on the council was, nobody on this council remembers that, because they're all new. It was before, prior to this council, and prior to most of this board too. That's how long ago it has been. And we tried, and Tammy can tell you that we tried many, many times. And it just, we were not getting the reception on the other side that we were hoping to get, you know, as at least, you know, as a out of respect for nothing else, but it was pretty frustrating. And we were not talking about a quarterly meeting either. We were talking about one meeting a year. That's what we were asking for. But anyway.
Yeah, but I mean, Kathy, I mean, I'd be fully supportive. We were trying for a reason. I don't think you're, if anything, I think you probably are just sensing frustrations, not a difference of opinion about it being a good idea or not. Because I'm also ghosting a certain individual who is probably seeking support at the moment, and I'm choosing not to engage because, you know, it's somewhat convenient. So not intentionally, I just haven't gotten around to it.
Yeah, it's a funny time in the election in Belmont, but yeah, happy
Yes.
to. I'm happy to, if everybody's comfortable, I'm happy to work with Rena to try to figure out the best method.
Yeah, anything that helps will be appreciated.
All right.
Okay. And then the only thing I had was I also attended the HIA meeting, which was concentrated on new development in San Carlos and Belmont, which was not a surprise. So we're going to have our work cut out for us going ahead. Going on to communications. Rena, did we have any communications other than the one I forwarded?
No, we didn't have anything else, Kurt.
Okay.
And I shared that with all the board members. I'm not sure if you saw the email. It had to do with San Mateo County LAFCO. There's a special election for what was the term, Kurt, the position?
This is
alternate.
Well,
alternate. There you go.
LAFCO has 2 special district representatives and an alternate. And apparently the alternate seat is vacant because the previous alternate got moved up to be an actual board member. So they wanted us, well, first they asked if we had wanted to recommend somebody, and it didn't look like we did. And now we actually get to vote, and there are 3 candidates that they sent, and they had some descriptions of what their backgrounds are. One is from the San Mateo County Harbor District, Virginia Kirali, Donna Rutherford from the San Mateo County Mosquito and Vector Control District, and Chris Mickelson from Coastside County Water District. So, Tammy, do you have any comments on what type of member we might be interested in getting?
I mean, any of those people, and I recognize the, of course, the one from Coastside, and then the San Mateo County Mosquito and Vector Control District. I'm not familiar with Virginia. I don't know her, so either one of those 2 candidates probably would be fine. Because it is just a vote, right? You guys are just mailing in your ballot.
Yes.
Looks like it. So either one of those 2 would be.
I know
Somebody
Virginia
that
Shank Corelli very well. So
Oh, you do know? Okay.
she ran for San Mateo County supervisor on the primary, and she came behind Mueller. So she's also with the Menlo Park Fire Protection District Board besides this board here. So she's pretty involved in the county. So I know her pretty well. I don't know Rutherford. And I know Chris Mickelson a little bit too. So for me, it was between Virginia and Chris. I'll go for Virginia, probably.
Is this is this requiring are they asking you as a board to vote on this?
Yes, we get one vote.
Got it. Okay. And it's due.
So we'll have to name a candidate.
It's due October something like
17th, before the next board meeting.
I see.
Yes. So
who is the regular member right now, and what agency do they represent? I forgot. Rena, did you say?
It's actually Katie Martin, also of the San Mateo County Mosquito and Vector Control District.
Okay, all right. So obviously that might hurt Donna's chances. I mean, why we would want two people from the same agency. So thank you, Kat.
Sorry, question for council. I mean, this came in as communications. Can we actually take action on this under this item and vote on it?
It feels like a little bit of a stretch. I'm not sure if we've done this before.
I think it's every time we voted on this, it's always been an agenda item, as I recall.
Yeah.
Yeah.
I saw it was added on the agenda after I left.
Yeah.
So I mean, it is on there. So
Is it?
it's on there. It's under communications.
It's under communications.
It's on the agenda.
Well, the agenda that was printed and put in my packet only has communications.
No, it's on the new agenda. There was a revised agenda.
Okay. Yeah. I'm looking at the one on the web. Yeah.
I guess my first reaction was that, the coastside guy, just because he's more familiar with water issues and so on, may be closer to our needs. On the other hand, LAFCO has a lot more stuff related to the incorporation of bits and pieces of county into the various cities and some of those types of issues, rather than particular water issues. In which case,
I agree, because I know Chris Mickelson, and he's very good, but he is focused on water issues. And Virginia is a lot more well-rounded, county-wise, county issues, and that's why I'm kind of leaning towards Virginia. But I won't be offended if we choose Chris. But they're both good. But I would tend to favor Virginia over Chris.
I would have to throw a dart at the computer screen to pick one from the other. So I don't know any of them.
Don't break the monitor.
Right.
Same with me. I don't know them, so I'll defer to the other directors.
Yeah.
Yeah, same.
Okay, then I'll make a motion to vote to propose Virginia Chancarelli.
I'll second Lewis's motion.
Okay, so we can call the roll.
Okay, President Bella.
Yes.
Sorry, Vice President Bella.
Getting late.
That's fine.
Director Zuka,
Yes.
Director Schmidt,
Yes.
Director Jordan,
Yes.
and President Wheeler.
Yes.
We have a 5-0 passes.
Okay, then actually I have to send in our vote, so I will do that and provide a copy to the staff. Okay. Then I think we can move on to closed session after a short break.
Just a reminder, the closed session, Kirk, for you and Matt, for your information, what we suggested is to switch A and B over, because Jubin's going to be in the closed session to discuss B, and the attorney that was going to be there outside for item A is not available. So Julie Sherman's going to be in the closed session. She and I will just kind of share some emails exchange that we got from the attorney with you regarding A. So let's do Jubin first. We're going to talk about El Camino Real.
Does everyone have the link?
Yep.
Yeah, so Kirk, yeah, we took action on this item that Rena is talking about before you joined us, so.
We took action on 11A.
No.
The
switch.
Oh,
B to A.
the switch. Okay, no,
To do
that's no
B
problem.
first. Okay,
Okay.
all right.
I get it. So why don't we take a 5-minute break and meet up in the closed session?
Got it.
Okay, thank you.
All right, it is 11:15 p.m. and we're back in open session, and there's no reportable action from the 2 closed sessions.
No reportable action from 2 closed sessions. Okay. And so I'll give that information to Monique for the minutes. You're on mute, Kirk.
Okay, so I will close the open session at 11:16 and we should be done.
All right. Good
Have
night,
a good night,
everybody.
guys.
All
Good
right,
night.
bye-bye.
Bye.
Thank you.